Open, everyone. A minute to go until the start of cash equity trading. I'm Francine Lacroix in London with Tom McKenzie.
And here are your top stories. Fed officials offer mixed commentary on the outlook for rates after US inflation came in hotter than expected. Sterling weakens as UK inflation falls more than expected in January, driven by lower fuel prices. Plus, Barclays' fourth quarter earnings miss estimates across most divisions, but the UK lender is planning a share buyback of £500 million.
Now, Tom, let's take a look at the futures. It's all about inflation. U.S. inflation yesterday, UK inflation today, slowing down. It's still double-digit. It's still 5 times more than what we were hoping it would be. And then we have a number of earnings. We have luxury. We have, of course, Barclays and Glencore. And for the moment, futures are actually pointing to a lower start, Tom.
Yeah, as you say, markets reassessing the rate outlook then, given the fact that CPI, of course, came in just a tad higher than the estimates. The money markets now, option traders at least, starting to price in a 50% chance of a hike from the Fed in June, 25 basis points, assuming, of course, that March and May come through as well. The terminal rate as well, expectations there edging close to 5.3%. So that reassessment, the clarity coming through from the bond market, you saw about a 12 basis point move on the 2-year yesterday, but it's a little bit mixed when it comes to the equity markets. Downside across Asia, in fact, falling more than the session that you saw on Wall Street. Here in Europe then, Spanish IBEX currently down currently gaining 0.1%, adding 13 points. The CAC current is lower by 1/10. And here in the UK, the FTSE 100, just assessing that inflation data as well. We'll look at the pound shortly. FTSE 100 currently down 0.1%. Let's switch it over then and see how the pound is playing out, because that is the big currency mover in today's session, at least. When it comes to the question of inflation, the UK is saying, hang on a second, US, hold my beer, because this is where the focus is, at least for now. Currently 120 on sterling, dropping 0.7%. Yes, inflation came in at 10.1%, below the estimates and lower than the previous month. Fuel, a big impact there as well. Question marks then as to what that means for the BOE. Don't forget wage data coming in still very strongly for the UK. Futures in the US pointing lower by 0.5%. There's the US 2-year, 460 now. It got to 464 yesterday, just a move of 1 basis point today. Since early February, though, you've seen a rise in yields of about 50 basis points for the front end, the 2-year. $84 a barrel on oil, that's a drop of 1.4%. Inventory build-up in the US is part of the pressure on the oil space this morning. Fran.
Tom, one other thing, I mean, I love the expression hold my beer. Unclear to me whether you hold your beer to then go for a dance or whether you pick a fight. So we'll see what the inflation data between the two suggests. Let's get over to our Bloomberg Headline Managing Editor, Mark Cudmore. Mark, good morning. You're looking at the move in Treasury yields.
Good morning, Fran. I've never thought about the expression in that way before. But yes, I am looking at the massive move in front-end US yields over the last 2 weeks. We've just got past the US inflation data, but this move hasn't been about inflation so much as that massive jobs print almost 2 weeks ago. In the last 2 weeks, the whole front end of the curve has shifted higher. This green line is where we were at the close of February 1st. This blue line is where we are right now. Now, there's a couple of things to observe. First of all, we're up about 40 basis points for June in just 2 weeks. 40 basis points, pretty incredible. We're up 80 basis points for March 2024. Really, it's about pushing this pivot farther out the curve. You can see on this chart that before, the peak of the curve was around June. We were wondering whether, May, June might be around then. Now, the peak of the curve is actually September as priced in the market right now. So we've pushed out that pivot. And this is about the idea that jobs are so strong that, hey, maybe inflation may not rise again, but it might be sticky enough and will prevent the Fed from pivoting as was priced only a couple of months ago.
Okay, Bloomberg M Live Managing Editor Mark Cumnall, thank you very much indeed for that context. Now, some Fed officials have stressed the need for further interest rate increases, of course, to help tame inflation after US data did come in hotter than expected. Federal Reserve Bank of Richmond President Thomas Barkin is one of those keeping the door open to more hikes.
We may or may not choose to take rates up further if inflation continues to persist, but we'll have to see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists at levels well above our target, maybe we'll have to do more.
Okay, joining us now is Emmanuel Kopp, head of European Equity Strategy at Barclays. Emmanuel, good morning. Thank you for joining us in the studio.
Morning.
Where does this leave your rate trajectory, your forecasts for Fed rates in the months and quarters ahead?
Well, higher for longer, I think, is the answer, right? So clearly the inflation is slowing, but not quick enough for central banks to kind of reverse course on the policy tightening. So we see the Fed probably hikes further, probably into June as well. So we look for a terminal rate of 5.25, 5.50, and then eventually in the second half of the year, we might see the Fed pausing and then cutting, but I think there's a long way to go before the Fed can basically, turn much more accommodative given the kind of sticky inflation environment.
Emmanuel, when do you think the Fed could start to cut? Because there was a lot of conviction, let's put it that way, diplomatically in the markets a couple of weeks ago that they could even cut at the beginning of next year.
Yeah, so we've seen most of this cut priced in, now priced out now in the market, actually. So the market is not really expecting much from the Fed support anymore. As a house, we still believe there's a case for the Fed to cut rate in December. But again, I think there's a long way to go before we have strong conviction there, right? So clearly the message from the Fed is that it's way too early for them to make a U-turn on policy tightening. Inflation just too high. In some cases, growth is actually very strong as well, right? So there is no reason right now for the Fed to change course.
Well, on growth, 5.25, 5.50 is the forecast on the terminal rate from you and the team at Barclays. What does that do to the growth picture? You've talked about, we've been discussing soft landing, hard landing. You're suggesting maybe there's no landing at all.
Yeah, I think the debate has gone from hard landing to soft landing to no landing now. And I think the data we got yesterday in the US did not really give us much clue about this tug of war between higher rate and higher growth, how it is going to end, right? So as of now, you have higher inflation because growth is fairly resilient, and that's going to force central banks to stay higher for longer. So, what is the end game here? It's hard to say, but for the time being, I think the equity market should get some kind of comfort for a resilient economy. Bear in mind that for the past 6 months, most of the market participants were preparing themselves for hard landing, for an imminent recession. That's not happening now, but the price to pay for this resilient economy is that you have to deal with more hawkish central banks and higher interest rate.
But Emmanuel, could you see a situation where actually you don't see strong growth for at least 3-4 years, which is what the Bank of England actually is also trying to intimate?
Well, I think if you look at the UK, there's clearly a more acute stagflationary shock going there. And the Bank of England has made fairly clear that there's a limit to what they can do in terms of hiking rate without hurting the economy. So, in the grand scheme of things, we are getting close to the end of this tightening cycle. Now, the question is that from here, what is the direction of travel? And it's hard to see a significant easing in policy without a substantial growth weakness. I'm pretty sure that if growth is down, ultimately, central banks will do what they always do in this situation. They will come to the rescue and support the economy. But right now, what they are fighting for is credibility and high inflation, and that should keep them in a fairly hawkish mode for the time being.
So just as investors raise their bets on the terminal rate out of the Fed, they're moving them lower here in the UK, then on the back of that softer than expected CPI print. On the point of the BOE, do you expect them to push ahead with another hike in March?
Yeah, I think it's a possibility, but that's pretty much what they're going to be doing, in my view. And then from here, I think they're going to be, like other central banks, very data dependent. Again, we have sign of disinflation, right? So it's not happening quickly, but the broader inflation dynamic is slowing, and that should be a step in the right direction. That should give confidence to central banks that ultimately they will get inflation under control. But I'm not sure central banks, whether the BOE, the ECB, or the Fed, will commit to a very clear right path ahead.
One of the big winners last year was definitely value investing relative to growth investing. Does this continue this year?
I think it does. We've been reducing our growth underweight because, again, in some cases, we've seen a significant repricing lower in the growth stocks. But I think the new regime of higher for longer interest rate and more inflationary economic should support value. So value has been a very poor performer for 10, 15 years in the backdrop of very weak growth, disinflation, fiscal austerity, banking sector deleveraging. And now we're seeing some of these drags are reversing. So the rate environment should be more supportive of the kind of shorter duration part of the equity market. And if we end up with higher nominal growth, in particular with more fiscal spending being one of the instruments for government to support the economy going forward, that should help the value part of the market and banks in particular.
Emmanuel, thank you so much. You see that? I talk about value investing and I lose my voice. Maybe it's a sign. Freudian slip. Barclays, head of European equity strategy. Emmanuel Co stays with us and we'll talk about earnings. Coming up, we talk banks in general. We also focus in on Barclays, slumping as the lender misses estimates in both fixed income and equities trading. More on that shortly. And this is Bloomberg. Amazon acquired Zoox back in January 2020 for what reports suggested was $1.2 billion. Since then, the company has revealed its Zoox vehicle. This is, I think, a rectangular passenger-focused vehicle with no driver's seat or steering wheel. How would you describe it?
We describe it as a purpose-built vehicle, but it's really a robo-taxi. That's its purpose. And essentially, it's about transporting people from point A to point B on demand in the most effective, cleanest, and most enjoyable way.
So why won't you call it a car?
Because a car is, there's an inference that there is a driver. Whereas in our robotaxi, there is no manual driving. A human cannot really drive it to transport passengers. So we want to make sure that that mindset, that shift, that distinction is clear.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to the Open. We are 11 minutes into the European trading day. A mixed picture when it comes to inflation, softer than expected here in the UK, higher than expected in the US. European markets, currently the benchmark down 0.3%. A lot of action in the gilt markets, yields coming in sharply across the curve, down 10 basis points on the 5-year. The pound under pressure as well. It's currently 120, that's a move low by 0.8%, Fran.
Now, Barclays shares have plunged, to say the least, this morning. They're down 6.8% after the bank missed estimates in the fourth quarter for fixed income and equities trading. Now, the bank said it would start a fresh buyback of as much as £500 million of shares. Well, joining us now is Bloomberg's Michael Moore, who heads all of our banking and finance coverage here in Europe. So, Mike, if you look at the key takeaways, I mean, there's nothing really good about it, but does it warrant a 6.5% drop in share price?
Yeah, I think that is taking some people by surprise that it's this stark. You did see them miss on profit, miss on revenue. In the trading and investment banking lines, they were a little short, but it wasn't a huge miss. I think, what we've seen kind of in this earnings season is bank investors are saying, okay, profits are coming up. We're expecting a bigger chunk of that to come back to us in dividends and buybacks. And banks that haven't pumped up the buyback have been punished. Because you have seen banks like UniCredit and BNP really step up that buyback, and I think that's where a lot of the attention is. Barclays did one in the middle of last year. They are doing a new fresh 500 million, but that kind of came in as expected. It wasn't a step up in some ways.
Yeah, they also raised the dividend. So what have they been saying? What have executives at Barclays been saying about that capital return?
They, I think the call's still ongoing, but they're kind of preaching their conservative approach. They have come back in the middle of the year before of doing this in pieces. There was a lot of attention last year on the overissuance problem that cost them quite a bit of money. They vowed that's not going to happen again. And they did reduce the bonus pool, particularly for people who were involved in that mishap. So we are seeing some accountability there. But I think, I think some investors were disappointed by the results.
Yeah, probably, to say the least. Where does Barclays go from here then? What do they need to do to get back on track?
I think they have been gaining share in the trading and investment banking world, picking up some of what Credit Suisse is losing. The Europeans have been gaining back a little share from the Americans over the last few quarters, but that seemed to stall out in the fourth quarter. I think investors want to see that pick up again. The CFO was on the call saying we expect to gain more share in trading over the next year. So I think investors want to see that come through. There has been some leadership change in the investment bank, in the equities trading division, and to see if they can pick up more as Credit Suisse pulls back in some of those businesses.
Yeah, I have to wonder if there's a comparison effect as well in terms of how investors are looking at this, given that some of their competitors, particularly around FIC, did really well.
Yeah.
Thank you, Michael, of course, for breaking down that story for us. The stock currently, Barclays down 7.4% in the session. Bloomberg's Michael Moore, of course, from our team, analysing the results out of Barclays. Let's check in on some of the other stocks on the move at the open. I know this is a favourite of Francine, so I might let her chime in here. LVMH. And a new men's creative director.
What are you insinuating?
Are you a Pharrell fan?
I mean, it's an interesting choice. So yesterday, I was kind of like scouring social media, which is always a good. Thank you to our producer, to our millennial producer who knows how to pronounce his name. And actually, it seems like it's a 50-50, right? Some people say, look, he's a millionaire. You could have, you picked a young designer with potential. And others saying he's really led the mark on this. So let's see where we land. His first collection is June in Paris. Menswear.
There we go. Put that in the diary. June. Paris.
One for you.
Pharrell. Currently, LVMH getting 0.2%. ASML, range-bound, flat essentially, but they've come out with a report that maybe one of their employees in China has taken some of their data, essentially. Glencore down 2.5%. They came in very strongly on the coal side of the business, but it was a miss broadly in terms of EBITDA. But they are paying out more than $7 billion in dividends and buybacks. So much for the green transition. Coal powering Glencore there, but the stock down 2.4%. Fran.
Now, still with us, Emmanuel Co, head of European Equity Strategy at Barclays. Emmanuel, so leaving the banks to one side for obvious reasons, when you look at the other industry groups, luxury is also, not everyone is doing quite well, depending on where you sell, if you can't sell in China, or if China's not opening up as quickly as we think. What are the industry groups, given these earnings, that are investable right now?
Well, I think, broadly speaking, we've seen earnings coming out okay, given the fairly low expectation. I don't think anyone expected earnings to be a blowout for Q4. And in the case of luxury, yeah, China has been a weak point in Q4, but I think the market is somewhat allowed to hope that things will get better next year. So I think the China reopening theme is still something which has legs, a sector which are exposed to Chinese demand. And you have a very large range of sectors that should benefit. Luxury is the obvious one, and maybe that's something people have been piling in straight away. But if you think about travel and leisure, that should see tourists coming back in Europe. If you think about some of the industrials, some of the consumer sectors, tech, semiconductors, we think this sector should see some of the demand support coming back from China, and at the same time, some of the supply disruption easing as well, right? So in most cases, I think cyclical sector would benefit from this China reopening, but in some cases, and luxury is one of them, you've seen quite a substantial share price performance already, and I think some maybe consolidation here makes sense. Yeah.
And you go through the earnings picture, earnings to date at least, and you're starting to see earnings per share, EPS growth, more resilient in Europe versus the US. Does that divergence continue?
I think for the time being, well, what we are seeing is that, first, Europe has been benefiting from a significant currency support. Euro has been weak for most of last year, and you get some benefit of that in Q4 earnings. And as of now, we get some relief from the energy shock losing intensity, so that should help margins to some extent. and demand is holding up as well, right? So, you know, it's hard to see over the very long run Europe and US momentum diverging, but for now, I think Europe is able to cope with the uncertainty, and to some extent, given that some of the stagflationary shock is moderating, that should help you know, earnings to be more resilient. And bear in mind that for the past 10, 15 years, the corporate sector has been extremely cautious in terms of capital allocation, in terms of costs. So, you know, we think corporates are in a fairly good shape to absorb some of this slowing in demand that we are seeing now.
Emmanuel, energy was definitely the outstanding sector last year, right? Outpacing everything else by a wide margin. Today, we also have Glencore earnings in the commodity space. What happens to the sector in 2023?
Well, we've seen a bit of, you know, profit taking on energy, which is understandable given the sector was up very, very strongly. And you've seen in the last couple of months this kind of inflation trade being reversed. But we still like the sector fundamentally. And to the point on China, you know, we're not very sure that China will be overstimulating their economy. So we're not very pro, you know, mining or heavy commodities in our allocation. But we think energy is a way to play China consumer. We're going to see more airline departure. We're going to see more road traffic. So oil consumption will pick up in China, and that should help the sector fundamentally. And on top of that, well, as we discussed earlier, we are still having fairly high inflation, and we think one should still have some inflation hedges in portfolio. So we quite like energy within the commodity complex.
Okay, Emmanuel Cole, always excellent on the China impulse for these equity markets, and of course all things central bank as well. Head of European equity strategy, Emmanuel Cole, potentially some upside there as a result of China when it comes to travel and leisure. Energy still in favour. Coming up, we unpack the latest inflation data from the UK, assets here in the UK, gilts and the pound moving on that news. Stay with us, this is Bloomberg.
Very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them, and so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value, and the kind of transparency that they want.
Are you seeing a labor shortage right now, and what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Welcome back to the Open, everyone. 22 minutes into the European trading day. We look at equities. We should probably also look at everything in between: bonds, gilts, Italian BTPs. A lot of stuff is on the move today. Now, stocks and actually futures in the U.S. are falling. We talk about rates in the U.S. We talk about rates here in the U.K. And actually, we just look at CPI. There's like a general obsession with inflation at the moment, with European stocks down 0.2%.
Yeah, gilt yields coming in sharply, the pound under pressure. That after UK CPI fell more than expected, with prices rising 10.1% in the year to January. That makes it the third consecutive month that the inflation rate has fallen, but the figures remain stubbornly high, more than 5 times, of course, above the Bank of England's targeted level of 2%. Joining us for more on this is Bloomberg's Lizzie Burson. Lizzie, break down the data for us. What stood out for you?
Well, as ING says in a note this morning, 1 month doesn't make a trend. It's nice to see inflation below expectations, but it's still more than 5 times the Bank of England's target. It's still stubbornly high when you compare it internationally to the US, France, Germany. The good news is, though, it's the biggest downward contributor was food and fuel, and this is what the average Brit is buying. And the other thing that the Bank of England's Monetary Policy Committee will really be looking at is services inflation. That fell from 6.8% to 6%, and the reason they're looking at it is to see how much companies are passing on the high wage bills, higher energy costs, so that bit's reassuring for the BOE.
Lizzie, I mean, the BOE and certainly the governor still thinks that inflation will fall quite significantly this year. Does this point to another direction? It's slowing, but as you say, it's still above 10%.
Yeah, well, the bank has said that it's near the end of this run of rate hikes, but economists are split as to whether you're going to see 1 or 2 more. And in terms of what the market thinks, actually they've pared back their bets aggressively off the back of this print. So they did see a peak of 4.69% in September. Now they see 4.55%. In terms of how officials are going to be weighing up these numbers, I spoke to a senior BOE official who said they're really concerned that businesses know people have got pandemic savings. They can reach into them and pay the higher prices, and businesses aren't going to cut prices until people stop buying the goods. Now, interestingly, the chief economist of the Bank of England, Hugh Pill, said they've got this rule of thumb where a third of the direct effects of inflation equals the indirect effects. This official says they reckon it's an even stronger multiplier than that. So more than the jobs data, the headline inflation print, what they may be looking at for the March decision is the inflation attitude survey, the decision makers panel, to really gauge what inflation expectations are for households and businesses.
Lizzie, thanks so much. Lizzie Burden there with the very latest on this inflation data and, of course, the ensuing market moves, Tom.
Yeah, indeed. Talking of the markets, let's check in on some of the individual corporates on the move. Barclays taking a big hit in terms of the miss on their earnings. Almost every division coming in lower in terms of their earnings and their results than had been expected by these markets. Currently down 8.2%. There you go. Yes, they have announced a share buyback of about £500 million. And have raised the dividend, but that is doing nothing to reassure investors. ASML currently just up 0.1%. There's news around a former employee in China apparently stealing data. Export controls may have been violated. The company said Glencore down 1.8%. EBITDA just below the estimates. They're going to be paying out more than $7 billion in dividends and buybacks. Coming up, Fed officials say higher rates may be needed after US inflation comes in hotter than expected. We're going to discuss that next. The markets here in Europe currently down 0.2%. Futures in the US lower by 0.5.
We look also at Barclays. So Barclays shares probably one of the biggest companies that we need to look after today. Shares down some 6% after fixed income traders fell short of estimates. The bank also said it would start a fresh buyback of as much as £500 million of shares. It's in line with consensus. Maybe analysts were expecting more. This is Bloomberg.
that go wrong, and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Fed officials offer mixed commentary on the outlook for rates after U.S. inflation came in hotter than expected. Sterling weakens as UK inflation falls more than expected in January, driven by lower fuel prices. Plus, Barclays slumps as fourth quarter earnings misses estimates across most divisions. The UK lender is planning a share buyback of £500 million. Tom, what are you looking at in the markets?
Yeah, a mixed reaction, of course, when it cocomes to US inflation versus UK inflation. As you said in the headlines, UK inflation coming in below the estimates. Now markets starting to price in a terminal rate by the BOE of 4.55 from close to 4.70 the day before this data came out. So that is playing out across these markets. You're seeing gilt yields coming in strongly, and you are seeing pressure on the pound. Across the equity markets, then the benchmark here in Europe currently down 0.1%. The UK story playing into what's happening in the FTSE 100 when it comes to the corporate earnings, particularly the drag from Barclays, but also Glencore, disappointment as well there for the minor. Currently just down 0.1% for the FTSE 100, but you can see that divergence versus the DAX in Germany, holding up gains of 0.3%, up 47 points. Let's switch it over and see how things are playing out across these sectors then. And of course, to refresh the memory in terms of that inflation print from the US, slightly above the estimates. And in terms of the terminal pricing, you're looking at closer to 4.3% and a 50% chance now. Money markets pricing a 50% chance of a hike in June from the Federal Reserve. Across your sectors then, a bit of a mixed picture. Top of the list, producer, consumer prices, goods, currently down 0.7%. Telecoms up 0.5. At the bottom of the list, though, you do have basic resources. Glencore, again, a factor there, but also oil under pressure. Some inventories around the US adding to a bit of a drag on WTI and Brent. Currently, basic resources down 1.4%. Banks as well. There you go. That's the Barclays impact there. Banks down close to 1%. Fran.
Now, some Fed officials, Tom, have floated the idea of even higher rates to help tackle inflation after data showed U.S. consumer prices rising higher than expected. I mean, we say rising higher, but really it's a touch higher. They were pretty much in line with expectations. The Federal Reserve Bank of Philadelphia President Patrick Harker believes the end is in sight.
We are reaching a point where we'll have done enough. Exactly where that is, we're going to have to let the data dictate that. It's going to be above 5% in the Fed funds rate. How much above 5? It's going to depend a lot on what we're seeing.
Well, joining us now is Raffaella Tenconi, Chief Economist and founder of ADA Economics. Raffaella, as always, thank you so much for joining us. What did you learn from the U.S. inflation number? Was it the commentary afterwards that is pushing markets to believe interest rates will stay higher for longer?
Hi, good morning. Well, U.S. inflation is more or less behaving as expected. Right now, it's largely influenced by energy which is driving the downturn of the last 3 months. And we are at the point where food inflation is beginning to turn, very, very important, and will be a driver also in the next few months. But on the housing market, de facto, you still have an inflationary housing market, and that probably continues maybe for another 6 months. But fundamentally, we are in a deceleration environment. And for the Fed, the question is simply, where they feel comfortable in Fed funds, whether it's 5.75 is our current guidance, but it could be all the way up to 6, I think.
Wow, okay, so 5.75 is your guidance, could be up to 6. It's the services component that is remaining sticky. You talked about housing as well. Of course, there's a bit of a lag factor there. What is your conviction that 5.75, 6 is going to actually have a material impact on services?
So 6% is, in our models, what really breaks the housing price trajectory. So especially for US inflation, where housing has a big weight, is what it will tilt house price levels to actually drop this year. So from a monetary policy perspective, it is an effective way to bring inflation down this year. That being said, in terms of 5.25, as long as you hold it there for a year, I mean, inflation will still come down slowly and you create less damage to the economy. And just to add a little bit of a point in terms of services inflation is not really influenceable by monetary policy right now. You can influence commodity prices and housing, but not services.
When do you have, Rafaela, because of the lagging time of monetary policy, where do you have the optimum window of understanding what the hikes so far have done to the economy? Is it now, or do we need to wait 3 months?
I think you need to wait a couple of months, definitely, because the labor market in December and January in the US was actually stronger than the trend that we had seen the 8 months before that. We do have now more indications in terms of anecdotal evidence and surveys that job cuts are coming. So in the next 3 months, you should see the data re-engaging in the loosening path that we expected. But I would say fundamentally, you need to be aware that we have decided to do the green transition very fast. And that puts an enormous strain on the labor market. So what you can expect from the US is that the unemployment rate probably rises maybe at most 1 percentage point. That is enough for the Fed to pivot at some point in the next 12 months. But in the next few years, you really have a labor shortage problem, which has second round effects on inflation.
Yeah, you talk about that mismatch between the inflation targets of the central banks and that need to power that green transition and how those two collide. What is your assessment? We were talking to Barclays earlier, and they were saying, look, there is a potential scenario where you get essentially no landing, where inflation remains high and growth remains resilient. Is that plausible?
It's plausible. I mean, historically, high inflation is associated with quite strong growth, actually. Eventually, also is very damaging for currencies and the banking sector, but that eventually takes many years. But to be honest, I think what is more likely right now is that inflation has peaked and will come down to, let's say, under 5%, definitely next year. Growth re-accelerates over the course of 2023. So you don't really have a recession that generates the lower inflation permanently. And then you accumulate all of this inflation costs over the years. So if you want to tackle the inflation problem, certainly monetary policy is important at this stage, but the bulk of the effort is in the fostering of productivity, which is outside of the mandate of the central bank.
Rafaela, we also had UK CPI this morning. Is it fundamentally different to the Eurozone and the US?
No, it isn't. Maybe it's a little bit more behind the cycle, but fundamentally, UK inflation has peaked. It is largely driven by energy. It should also begin to see some softening in food inflation. You saw a little bit of that. And of course, housing is still inflationary and probably underestimated, actually, in the current estimate. So it's going to take some more time to come down, but the trajectory is the same. Of course, in the UK has bigger shortage problems in terms of labor. and probably also has bigger problem in terms of housing, because housing inflation in the UK has structural historical problems, and right now these are going to be inflationary for quite a long time still.
Okay. Rafaela, just very briefly, did the BOE hike again in March?
Yeah, it's plausible that we peak at 450. Okay. But even at 4, we are in restrictive monetary policy territory.
Okay, Rafaela Tanconi, really, really interesting insights. Thank you, Chief Economist and founder of ADA Economics on the inflation prints out of both the UK and the US. Thank you. Coming up, more from our interview with Canadian Defence Minister Anita Anand. We're going to discuss the latest on military aid to Ukraine. More on that next. This is Bloomberg.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
Enjoy the excitement of a night of music at Boston Symphony Hall with BSO Now. Watch brand new Boston Symphony Orchestra performances, behind-the-scenes storytelling, and memorable archival concerts, all from the comfort of home. Use our free 24-hour trial and see why the Boston Globe calls it musically rewarding. And the Berkshire Edge says the orchestra has never played better. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg. Earnings season continues.
The chips are down. Earnings coming in fast and thick.
A slew of bank earnings this morning.
Bloomberg breaks the numbers first.
Numbers coming through from Shell.
LVMH numbers are hitting the tape right now.
We had a very good set of numbers in the fourth quarter.
Feel confident with the guidance we've given.
The situation has changed completely.
With exclusive expert analysis.
Europe's most valuable company.
Trending towards the higher end of its historical range.
That can continue. How do I play this into 2023?
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
If Putin wants this war to end, all he has to do is leave Ukraine. And that is exactly what the fact of the matter is. And until that occurs, we are going to be standing strongly with our Ukrainian counterparts.
Canadian Defence Minister Anita Anand there speaking to Maria Tadeo exclusively earlier. Meanwhile, the EU is also proposing a new 11 billion euro sanctions package against Moscow, including targeting assets held by the Russian Central Bank. Now, a draft version of the proposal seen by Bloomberg also says the bloc's executive arm is actually looking to strengthen reporting obligations on frozen assets linked to sanctioned Russian companies and individuals. Now, for more on all of this, we're joined by Maria Tadeo in Brussels. Maria, good morning. So what exactly is being proposed? Does it have teeth?
Yes, and Francine, look, we are finding out some details because the head of the Commission, Ursula von der Leyen, is speaking as you and I speak. She says and confirms what we were expecting at this point, that there will be a new package of sanctions on Russia. Remember the timing of it. It was expected. The European Union wanted to send this message of essentially the longer you stay in Ukraine, the more painful this is going to get for the Russian economy. And today she says there's a new package coming. This will be the 10th sanctions package from the EU to Russia. She says it will be worth about 11 billion euros. A lot of the focus will be on technologies and export ban that continue to fuel the Russian war machine. And there's a reference to Iran too. Not a lot of details on the banks. That's the story that we reported overnight, which suggests, and this is interesting, that the European Union will also ask European banks to provide details on the Russian frozen assets. And remember, Francine, the assets have been frozen for a year now, but there is a growing political debate that at one point they could be, well, unfrozen to be used to rebuild Ukraine. This is a very thorny legal issue, but we know there's a number of countries pushing for it that say it's not European taxpayers that should pay for the damage that Vladimir Putin has created. And the first step to do that would be to reach out to banks and say, what do we have? To put a list together of the assets and the value that could be at hand.
Yeah, you'd imagine that argument would play well with the voting public across Europe, wouldn't you? On the conflict itself then, Maria, NATO defence ministers meeting, and you've, of course, been speaking to the Canadian defence minister. What have we learned?
Yes, and Tom, by the way, you make a very good point. When you make Russia pay, that goes well with the voters. But there are questions to some that say this has never happened before. You've never confiscated and have assets seized to give it to another country from G7 jurisdictions. What happens to the legal basis going in the future? But to answer your question on the war, this is a very sensitive moment, Tom. Everyone that I speak to repeats these things. There's really a lot of concern and tension about what's going to happen next week. You have the February 24th anniversary, for lack of a better word, that is coming, but also concerns about the new offensive. And remember, this is the spring offensive. But yesterday, the head of NATO said it's not spring. It's potentially happening already. It may be underway because the information that they have is that Russia sending thousands and thousands of troops to the border. They're willing to accept high casualties for this if that means that they make inways into the front line. So there's a lot of concern that actually that offensive may be about to start or is already in some ways already starting. That keeps Ukraine engaged, and it also means that the need for weapons for them becomes even more severe.
Maria, I mean, something that we need to really try to get to the bottom of is also, I mean, when you go back to this report about, you know, the EU sanctions aiming to make banks divulge some of these Russian assets that have been frozen, like, do we have any idea at this point who that might affect or from what countries?
Yes, and Francine, you know, it's a very good question. You know, who has these assets? Are they stored? Is it France? Is it Italy? Where are they exactly? And what kind of relationship do they have with Russia? Not just the central bank, but also some of the state-owned companies. Remember, a lot of that has been sanctioned and is frozen too by the European Union. But it goes back to the earlier point. This is in many ways, Francine, something that has never been done before to that extent. And perhaps that explains the reason why today von der Leyen in the speech, she confirms there's a package of sanctions that will be announced. She talks about 11 billion euros. It's not clear where those 11 billion euros come from, but there's very little detail, on the banks. You also have to go into the transactional client relationship that a bank would still have with those clients in Russia. Would they be happy to collaborate? You would assume yes, but there's a lot of questions around this idea of the frozen assets and what to do with them.
Maria, today in Brussels, thank you on the debate around those Russian frozen assets and what could be the start of a spring offensive by Russia as we count down to 12 months of that conflict. Let's get the Bloomberg First Word News now with Alice Atkins. Alice.
Hi, Tom. The US says 3 unidentified objects shot down by the military since last Friday were not used for spying, but likely tied to some commercial purpose. Signs are emerging that both the US and China are trying to figure out a way past the balloon dispute. This, as the US Secretary of State is said to be considering a meeting this week with the Chinese opposite number. Chinese stocks have become must-haves for hedge funds again. The latest 13F filings show they loaded up on the shares last quarter as Beijing abandoned its COVID-0 policy. Warren Buffett's Berkshire Hathaway, meanwhile, reported an unusually quick reversal in its TSMC position. The legendary investor slashed his holding of the Taiwanese chip giant just months after disclosing he's bought a major stake. Louis Vuitton has named music producer Pharrell Williams as its new menswear designer, filling a role previously held by the late Virgil Abloh. The French brand says Williams will unveil his debut collection at the Paris Men's Fashion Week in June. Abloh was Louis Vuitton's star menswear designer before his death from cancer at the age of 41. Australia's central bank chief says he won't be resigning as he made his first public remarks this year. Philip Lowe faced a Senate committee after calls from some lawmakers for him to step down over earlier guidance that interest rates were unlikely to rise before 2024.
Sometimes the fact that it's all sheeted down to me is a bit unfair, but because it's the board. There are 9 of us, including Michelle, who make these decisions, and we take them collectively. It's not just me making these decisions. There are 9 people based on the advice of a large staff.
Global News, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Alice Atkins, and this is Bloomberg. Tom, Francine.
Alice Atkins, thank you. Let's check in on UK assets then. Moving on the back of the news that inflation came in slightly softer than expected, still 10.1%, but you have yields on gilts moving in sharply, particularly at the front end. 2-year currently a move lower by 12 basis points, 371. The 5-year at 338. That is also a move in a contraction in terms of yields by 12 basis points. The pound remains under pressure, trading at 120, down 0.6%. UK assets, more a reflection of the earnings story than arguably the inflation print, currently range-bound 7,949 on the FTSE 100. All the action, though, in the pound and gilts. Fran.
Now, coming up, we get the latest on a Chinese data breach at ASML. We'll look at chips and what that means for the future. This is Bloomberg. So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a 3-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Welcome back to the Open, everyone. 52 minutes into the European trading day. Across the board, we have a little bit of a mixed bag, pretty much flat for European stocks 600. Now, what investors are trying to figure out and trying to weigh up is really the impact of the latest inflation data from the US and also from the UK, and what that means for the outlook on interest rates. They also digested some of the earnings from major companies, including Barclays. That stock down 8.5%, Tom.
Yeah, bit of a brutal day for the UK lender. Here's a look at some of the other events we are following today. The IEA and the IEF OPEC Symposium, they're the acronyms for you, takes place in Riyadh. The African Union Summit, meanwhile, is taking place. I should note, oil has been under pressure, of course, so it's really interesting to zero in on that event. Leaders are going to gather in Ethiopia to discuss a free trade in the continent. Plus, it is the second day, as Maria was saying, of the NATO defense ministers meeting. We're going to hear more from Jens Stoltenberg, the head of NATO, of course. And at 1:30 p.m. UK time, we're going to get US retail sales figures.
Now, ASML says a former employee in China misappropriated data about its proprietary technology. The leading chip equipment maker added that export controls may have been violated as a result. Now, joining us now is Bloomberg breaking news reporter April Roach. April, what exactly do we know about the situation? What has ASML said so far?
Yes, so ASML said a now former employee in China stole data about its proprietary technology, and the semiconductor equipment maker said it is currently investigating the incident and that it has already informed the relevant authorities. However, it did say that the incident may have violated certain export control regulations. And ASML made these comments in its final annual earnings statement, where it also highlighted that the company is seeing increasing security risk trends, such as phishing attacks and attempts to steal its intellectual property.
Okay, investors so far taking this in their stride, the stock up 0.4%. What is the impact on ASML's business?
Yeah, so it is important to say that it is a bit difficult at the moment to say what the exact impact will be on ASML's operations. There's still much uncertainty surrounding the finer details of the incident. And ASML said it did not make a statement earlier on this because the impact is not material to its business. However, the fact that certain export control regulations may have been violated suggests that this is potentially more severe. And it's also important to note that this is not the first time that ASML has made charges against Chinese entities. Last year, it accused a Beijing-based firm of potentially stealing its trade secrets.
So, April, did ASML actually provide any update on export controls of its advanced chip-making machinery going forward? Or how does that change their relationship with China?
Yeah, so Bloomberg reported last month that the US has secured an agreement with Japan and the Netherlands on export restrictions of its advanced chip-making machinery to China. And ASML said in its earnings statement that it expects that these new controls will take many months for governments to enact these controls. So yet to see particularly what will happen there. All we can do is wait to see what update ASML will provide.
Okay, April Roach, thank you very much indeed. Yeah, it's really interesting given that ASML's executives, the CEOs, actually pushed back on the pressure they've been under by the US to further restrict access to some of their Chinese clients. Currently, that stock gaining 0.3%. We check on your broader markets now. European equities are range-bound. Futures in the US down by 0.4%. The sell-off, or I should say, the buy into UK gilts is pronounced. Gilt yields coming down 12 basis points on the 2s and the 5s. Money moving into gilts on the back of expectations that the peak in rates is going to come in lower for the UK. 4.55 is the expectation now from markets. That is it for the European Market Open. Surveillance Early Edition is up next. This is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Chairman of the Federal Reserve is obviously an important job. What do you do to relieve the stress other than interviews like this?
As you know, I like to ride my bike.
Is that safe, riding a bike?
It's safe if you stay on the bike.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close. Welcome to Bloomberg Crypto.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. CPI aftermath. Fed officials offer mixed commentary on the outlook for rates after U.S. inflation comes in hotter than expected. Sterling weakens and gilts extend, gains as UK inflation falls more than forecast in January, driven by lower fuel prices, plus Barclays slumps more than 8% as fourth quarter earnings miss estimates across most divisions. The UK bank is planning a share buyback of £500 million. Now, first thing is first. Good morning, everyone. Let's check on the markets. Quite a lot going on in terms of gilts, but also Treasury yields. We did have that important inflation print from the US, pretty much in line with expectations. The UK inflation also pretty much in line, but of course it's the outlook on interest rates that's moving markets and investors weighing the impact of what that means for monetary policy. They're also digesting a lot of results from major companies. I was looking at the two-year Treasury yield. I don't know if we have that up, but overall, the two-year actually remaining near the highest level since November. And then a couple of other quirks that we're watching, of course, is sterling oil falling for a second day after an industry estimate had pointed to a large build. The other thing we need to watch out for is the People's Bank of China adding more cash into the financial system to meet a rebound in loan demand after the nation eased COVID restrictions. Now, there's not a huge difference whether you're sitting in Italy or whether you're sitting in Germany or France. So let's get the European map to see if there are countries that are doing much better than others. Overall, they're pretty much range bound. So I would say they're between being flat and maybe gaining 0.2%. So some Fed officials have stressed the need for further interest rate increases to help tame inflation after U.S. data came in hotter than expected, slightly hotter than expected. Now, Federal Reserve Bank of Richmond President Thomas Barkin is one of those keeping the door open to more hikes.
We may or may not choose to take rates up further if inflation continues to persist, but we'll have to see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists at levels well above our target, maybe we'll have to do more.
Well, joining us now is Mike Bell, JP Morgan Asset Management, a global market strategist, and Bloomberg's Ksenia Galuchko. So thank you both for joining us. Mike, let's start off with you. What did you learn from inflation yesterday in the U.S.? I don't know whether it's the commentary that is moving markets rather than the inflation print. It feels like it for sure.
Yeah, I don't think there was a huge amount of extra data in what we saw from the inflation print. I mean, I think ultimately the key question that markets need to know the answer to is, when's unemployment going up? Do we see the labour market break this year? And you look at things like the Conference Board's leading economic indicator. Every time in history they've been this weak, unemployment then goes up, you get a recession. So I think the market expects that, and if we get a recession, that's why I think the market is pricing in the rate cuts that you can see priced into the curve. But if you don't get that crack in the labor market, unemployment doesn't go up, and then the rate cuts don't come. That, I think, is the biggest risk to markets this year, not whether the Fed peak at 5.5, you know, it doesn't matter so much. The key question is, by the end of next year, are rates somewhere near 3, or are they still at 5 or even 6, 7%?
Yeah, and I hear this more and more, right? The idea that actually it's kind of like a bifurcation. It either goes well or it doesn't, and that will change everything. What kind of time frame do we need to look at to understand the lagging effect of monetary policy so far? Because that seems the key question here.
Absolutely. So I think if you look at the stock market, it's definitely thinking of the year ahead in general. So stocks have rallied tremendously, both in the US and Europe and China, on these expectations that the Fed will eventually pivot this year. Now, if we look at the bond market, especially after the US CPI data, we see a completely different reaction. So the bond market slumped yesterday, and obviously yields are much higher because the bond market is pricing in more rate hikes and them staying higher for longer. So the stocks seem to be much more optimistic than the bond market at the moment.
And so your hunch feeling, Mike, in that very good question, what happens with employment? Again, is there a timeline? How much of a slowdown will we see because of the hikes in 2022?
Yeah, history suggests that you should see unemployment rising this year. You look at most of the key economic indicators, things like the ISM Manufacturing New Orders Survey, the existing home sales, they're all at very weak levels that historically precede a rise in unemployment. So I think that we're just in that point in the cycle where the leading economic data is weak, and then there's a bit of a lag before it feeds through into a rise in unemployment. And so I do think the Fed will be able to deliver cuts as the market expects. But the risk to that is that we also see job openings relative to the number of unemployed people at very high levels compared with history. So that's the kind of small risk that maybe actually you see labor hoarding and you don't get the rise in unemployment that history suggests that you normally would do.
So what does that mean for what you're, is there anything that you'd be strategically positioning yourself on when it comes to treasuries, but also bonds?
Yeah, I actually think that the bond market is doing a pretty good job of pricing what's going to happen to rates. I think in the UK, there's a chance that actually rates need to come down a bit more over the next 2 to 3 years than the market's pricing, because I think that the UK housing market is going to struggle if rates stay elevated.
What's your take on this, Ksenia? So what are you looking at through all of our reporting, and also this idea that actually, services inflation is really the one to watch out for?
Yes, absolutely. Well, I think it's very much about stock picking this year. So more and more fund managers are really rejoicing this year because they think that it's their time for stock picking. So I think cyclical and value sectors are going to continue to do much better than growth, because obviously higher yields will continue to pressure tech stocks, and then these cheaper cyclicals like automakers, like banks, that benefit directly from higher rates will continue doing quite well. So this is the attention that is being paid to.
Okay, let's also look at some of the specific movers that we have today. So we have LVMH, we have Kering, we have a lot of the luxury sector, then we have Barclays down some 8%, and we have Glencore. So here with us, Joe Easton from our equities team with the stocks on the move. Joe, what do you have?
That's right, Fran. So as you mentioned, Barclays shares getting slammed today, down 8%, the most in almost a year for that company, as their fixed income revenue misses expectations. Their net interest margins are weak, and a £500 million buyback really not enough to appease analysts today. That stock also weighing on peers like Lloyd's and also NatWest as well. Some of the other stocks I'm looking at, as you mentioned, some of the luxury firms, we've got Kering today. That stock actually opened down around 4%. Given some concern around Gucci not coming back online quick enough over in China, and also some of the concern around Balenciaga sales dropping following those controversial adverts that we saw in November. Recovering, though, as analysts say that perhaps the worst is now behind them, and also that valuation pretty cheap. A couple of other ones I'll just go on to quickly. Carrefour and Ahold, two big grocers, one in France and one in Amsterdam, both of them seeing the benefit today of rising food prices and also managing to control their margins in terms of the wages and energy costs. Carrefour announcing a buyback of almost $1 billion, and Ahold looking to save around $1 billion in costs, spurring hopes that they could actually increase their buyback at the next report. And as you see on the screen there, both of those grocer stocks rising sharply in European trading today.
Joe, thank you so much. Joe Easton there with a very nice roundup of equities On the move, Mike, what does this mean for where you want to be invested in, but also in general, just value investing?
Yeah, I think if I look at equities at the moment, my base case is that we've seen the lows for equity markets, but we've obviously rallied a fair way off of those lows now. So I'm kind of looking around global equities for the bits of markets that haven't got back to their prior peaks and are still pricing in a fair bit of bad news. So China, for example, still a long way off of its highs. Some of the mid and small cap stocks in the UK still look quite beaten up. And then in the US, the banks still, I think, look quite attractive, down more than 20% from their highs.
Actually, it's amazing when you look at the banks. I mean, if you don't give back to shareholders in a meaningful way, or if it's already priced in or telegraphed, you're going to get slammed.
Well, that's the thing. That's why banking sector and energy are giving back through buybacks in a major way at the moment. They're trying to attract those shareholders because obviously earnings, especially for the energy sector, are starting to come down. Analysts are saying that the fourth quarter was the peak in terms of energy earnings, so they need a way to attract these. And then other sectors in commodities, in other value and cyclical sectors are also starting to pay out those buybacks and dividends in order to attract investors back to those shares.
Mike, what are you doing with luxury sector? So I know it's probably a China play that you mentioned, but if you look at LVMH and Kering, it's just widely different fortunes.
I think obviously it benefits in a world where you get China reopening. They've accumulated huge amounts of savings in excess of what they did pre-COVID, something like an extra $1 trillion of savings. So that's, I think, going to drive a pretty strong rebound in Chinese domestic demand. The question, of course, is looking for which stocks have already priced that in, because you've seen a pretty strong rally in some of the luxury goods sectors.
What do you do with energy, the outstanding performer of 2022?
Yeah, I'm more inclined to look at the bits of the market that did badly and haven't recovered, rather than the stuff that's already done extremely well, such as the energy stocks.
I mean, where do you look at energy? I mean, the energy versus ESG space, and we had Glencore today, I think, with record profits, is what you wonder where we are in 12 months.
Absolutely, yes. So energy sector is likely to come under pressure this year just because of its outstanding performance last year and because earnings are starting to come under pressure. Oil prices and gas prices have come down in the past few months, and they're already starting to exercise pressure on the margins of these companies. So like we mentioned, these buybacks could be a way for these companies to attract shareholders to them, but this will be a much more challenging year because commodities are coming down.
All right, thank you both for joining us. Mike Bell there, JP Morgan Asset Management, Global Market Strategist, and Bloomberg's Ksenia Galuchko. Coming up, more from our interview with the Canadian Defense Minister, Anita Anand. We'll discuss, of course, the latest on military aid to Ukraine. That's next, and this is Bloomberg. Amazon acquired Zoox back in January 2020 for what reports suggested was $1.2 billion. Since then, the company has revealed its Zoox vehicle. This is, I think, a rectangular passenger-focused vehicle with no driver's seat or steering wheel. How would you describe it?
We describe it as a purpose-built vehicle, but it's really a robo-taxi. That's its purpose. And essentially, it's about transporting people from point A to point B on demand in the most effective, cleanest, and most enjoyable way.
So why won't you call it a car?
Because a car is, there's an inference that there is a driver. Whereas in our robotaxi, there is no manual driving. A human cannot really drive it to transport passengers. So we want to make sure that that mindset, that shift, that distinction is clear.
The top names in business are on Bloomberg.
More and more people are frightened of the realities of today, That's manifesting in so many areas. Why would anybody put something into a 30-year obligation unless you believe something is better in 30 years? I'm not here to suggest it's going to be rosy in 2023, but what I'm saying for long-term investing, it's a better environment for long-term investing today than it was 2 years ago.
Nobody covers business like Bloomberg, your global business authority.
Well, we have a lot going on, of course, with the defense. The Canadian defense minister earlier on was speaking to our Maria Tadeo. Meanwhile, the EU is proposing a new sanctions package against Moscow that would include targeting assets held by the Russian central bank. Now, the draft proposal seen by Bloomberg also says the bloc's executive arm is looking to strengthen reporting obligations on frozen assets linked to sanctioned individual companies and, of course, individuals. So joining us now, Bloomberg's Maria Tadeo, who's in Brussels. Maria, thank you for joining us. Great interview with the Defense Minister of Canada. Ursula von der Leyen has just spoken in Strasbourg. What do we know about the extra sanctions?
Yes, Francine, and as you say, it's a very busy day. You have the NATO meeting happening at the same time. You have the head of the Commission also speaking and now confirming there's a new package of sanctions that is underway and that will be announced worth about 11 billion euros against Russia. We were expecting this to some extent. We knew that the European Union wanted to send this political message. The more the war goes on, the more painful this is going to get on the economic front for Russia. And you also have the top diplomat speaking at the same time in the same morning. A lot of this really goes to the urgency, this new sense of urgency that we see both on the sanctions but also on the battlefield when it comes to the war in Ukraine. As for the Commission today, they say a lot of the new sanctions will look into export ban technologies. They want to deprive the Russian war machine. We've seen the drones that continue to attack Ukraine. There are references to Iran here. There's a big question mark, however, and this is a story that we reported overnight that in some ways is the key in this debate, which is the frozen assets of the Russian central bank, the companies and the individuals that have been frozen now for a year. Now, we are reporting the Commission is looking for ways to get in touch with European banks to have them report what kind of transactional relationship they had in the past to try to figure out the value of the assets that are here in the European Union. And Francine, this goes back to a much bigger and fundamental question to some extent, which is there a possibility where the European Union decides we're going to confiscate the assets, use them, invest them, and give that proceed to Ukraine for the reconstruction of Ukraine? That plays well with the Eastern European countries. Yes, go ahead.
No, who exactly is it targeting? Like, this is the first story that I read, and congratulations to Alberto for getting that scoop. But it's aiming to make banks divulge frozen Russian assets. Like, how many are there, and from who?
Yes, and Francine, to be very honest, I don't think they know in great detail, and that's why they're doing this. That's why they want to now reach out to banks and essentially say, can we figure out what's going on here and what's the value of the assets? You want to say, or you want to start a debate about using Russian frozen assets to help Ukraine. First of all, you need to know how many, who has them, and what kind of transactional relationship they have. But beyond that, and the detail, and this is going to be a very long process. That's very clear, if ever it happens. Because remember, there's lawyers that say if you do that, the G7 jurisdiction is out of the window. But what it shows, however, is that this debate has gone from we can't even talk about it to now let's just test the waters and do some prep work in terms of what it can mean or could look like in the future. So it does show that this idea of why don't we make Russia pay, not our taxpayers, is to some extent gaining ground as the bill gets bigger from Ukraine.
So NATO defense ministers, Maria, are also meeting in Brussels on Ukraine. What do we know about what they'll decide?
Well, they're meeting for a day too, and Francine, beyond that, and of course, we're talking about the financial ramifications for this, but the war is also going on, and that was a message yesterday from the head of NATO. The spring invasion, it may not be a spring situation, it may be happening now as we speak, and according to NATO, what they see is that Russia has now fully mobilized thousands and thousands of units to the east of Ukraine. They're willing to accept a very high casualty rate. That means you have a lot of soldiers that die, but if that helps you move, they're willing to take that pain, and the problem is, For Ukraine, that means constant engagement. It means constant use of ammunition, constant use of weapons. So we talk about the fighter jets and the tanks, but there's also a real question about the ammunition, but also the production. If Ukraine burns through this very fast, the West needs to come up with ways to make them faster, not just for Ukraine, but also their own stocks.
Maria, thank you so much. Bloomberg's Maria Tadeo out of Brussels with the very latest. Now, coming up, the UK's inflation rate slowed more than expected, but still remains stubbornly in double digits. We unpack the data next, and this is Bloomberg.
make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
News breaks. No one covers the world like Bloomberg.
Return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority. From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, time for our daily UK segment. And UK inflation fell more than expected, with prices rising 10.1% in the year to January. Now, that makes it the third consecutive month that the inflation rate has fallen. The figures remain stubbornly high, more than 5 times above the Bank of England's target level. So joining us now is Bloomberg's Lizzie Burden to break all the data down for us. Lizzie, I mean, this, I guess, is welcoming at the margins, but it doesn't mean that we're going to go down as fast as Bank of England was hoping.
True. And if you look at the market reaction, the pound's fallen on this data, seemingly on the premise that this faster fall in inflation means you're going to have fewer hikes from the Bank of England. But, as you say, it's still more than 5 times the Bank of England's target. We're still in double digits. And if you compare this figure to the US, France, Germany, as you say, the UK's inflation is stubbornly high. Jeremy Hunt, the Chancellor, to his credit, has acknowledged that this morning. He says the fight is far from over because it validates him prioritising the fight against inflation.
The good news, if I can bring some of that out, is the biggest drivers of the fall were food and fuel, which is what poorer Brits are spending on. And also you saw that services inflation fell, even core services inflation, and that's what the Monetary Policy Committee at the Bank of England looks at to gauge how much companies are passing on higher wage bills and higher energy costs. So that's reassuring for the MPC.
So what are we expecting from Bank of England? I know that we're expecting one other rate hike in March, but that's now, I guess, on the table.
Yeah, and I mean, there's a debate between economists whether you get one more hike or two. Our economists at Bloomberg Economics say that this print today means that the pause is on the horizon. But if you look at WIRP, W-I-R-P function on the terminal, you can see that money markets have reacted aggressively to this. They've pared back their bets for where peak inflation will be. So it was 4.69% in September. It's now 4.55%. It was on 4.69 on Tuesday, and now it's 4.55%. In terms of how the Bank of England's going to weigh up these numbers, I actually think that there are parts of the BOE that would look past these headline numbers and look at more niche data points like the Inflation Attitude Survey, the Decision Makers Panel, because they're focused on inflation expectations for households and businesses. I was speaking to a senior BOE official who said businesses know that people have got pandemic savings. They're going to wait until people stop buying the goods before they cut the prices. So really it comes down to the inflation expectations for some corners of the BOE.
Yeah, I would urge everyone to go and also look at what Dan Hansen and Anna Andrade wrote today, saying, look, the key detail in the CPI was definitely the sharp fall in services inflation. And they think if we have a bit more support along that trajectory for, of course, the labor market would be enough for the central bank to keep rates on hold on March 23rd. That's the other big one. And then there was of course, there's still the labor disputes and I guess questions on whether the government would backdate some of the pay rises.
Yeah, indeed. And that's a story from our colleague Joe Mays today. I mean, this print today works two ways, doesn't it? Because while you've got high inflation swallowing up pay rises, you could say it validates the Chancellor's argument that you're prioritising inflation, that you can't be giving in to the union's demands, but you could also say that it gives the unions ammo to give them the pay rises to deal with the cost of living. It works both ways.
It does. But Lizzie, thank you so much. Lizzie Burden there with the very latest on that inflation data. And I will be covering all things UK every week on Thursdays at 9:30 a.m. in our half-an-hour special. We're also getting some breaking news out of Lufthansa. We hope you're not skiing. We hope you don't have to get back or leave today. Lufthansa is saying that IT system problems are causing some widespread cancellations. So if you have to go to the airport or if you're coming home for a flight, just check with your airline carrier. Coming up, U.S. inflation cools slightly, but Fed officials warn the fight against inflation may need to heat up. We have more on that story next, and this is Bloomberg.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders.
Watch Wednesdays on Bloomberg Television.
CPI aftermath. So Fed officials offer mixed commentary on the outlook for rates after U.S. inflation comes in hotter than expected. Sterling weakens and gilts extend gains as UK inflation falls more than forecast in January, driven by lower fuel prices. Plus, Barclays slumps as fourth quarter earnings miss estimates across most divisions, but the UK lender is planning a share buyback of £500 million. Now, good morning, everyone. Welcome to Bloomberg Surveillance Early Edition. I'm Francie Lacqua here in London. Now, some Fed officials have floated the idea of even higher rates to help tackle inflation after data showed U.S. consumer prices rising higher than expected. The Federal Reserve Bank of Philadelphia President Patrick Harker believes the end is in sight.
We are reaching a point where we'll have done enough. Exactly where that is, we're going to have to let the data dictate that. It's going to be above 5% in the Fed funds rate. How much above 5? It's going to depend a lot on what we're seeing.
Well, joining us now is Hetal Mehta, a senior European economist, legal and general investment management. Great to have you on the program today. I mean, what did you learn from the U.S., not inflation number, but actually the surrounding commentary yesterday?
That clearly the central bankers are quite worried about the second round effects and how much it's going to take to actually squeeze inflation out of the system, probably looking at needing a recession to get things back to target consistent levels.
Can we get away without a recession actually in the U.S., given all of the hikes that we've had so far, and given actually the Fed needs to do something to the labor market if you're going to get inflation down to a meaningful target?
We don't think you can, actually. We think that a recession is necessary. We're looking at something like a 1.5% peak to trough decline, and only then will we start getting inflation, maybe next year, closer to target. But we've got second round effects, high wages feeding through. There's evidence of that. And central banks have to be mindful that financial conditions have been loosening, and they've been banging the drum that they can't ease off just yet. And actually, the recession is probably needed to get all of the inflation out.
So, Hetal, what kind of recession? Is it going to be like a deep and ugly recession because there's maybe over-tightening from the Federal Reserve, or is it going to be a kind of shallow recession but maybe stays longer than we're expecting it to?
Probably somewhere in the middle, 1.5%, I think. Peak to trough would be, probably on the milder side, certainly milder than what we saw post-financial crisis. And the recovery, though, is going to be slow. We don't expect much in terms of employment gains. Once we even come out of it, it's going to be a jobless recovery. So, yeah, I'd say middling.
What if the labor market holds on? again, there's so much evidence at the moment, and it could change, very quickly, that the labor market is tight in the U.S., that it's very difficult to find the right people for the right jobs because of a lack of skilled workers.
Yeah, I mean, that's the problem we're seeing everywhere, including in Europe as well. The shortage of workers trying to cool the labour market. And we know the labour market's a lagging indicator, but we would have expected by now more cracks to have appeared. And that is one part of the puzzle where, the resilience has been quite astonishing.
We talk a lot about the UK and the fact that we have the other problems of the world, certainly the problems that we have in Europe and the US, but distilled and condensed in the UK. Is the situation very similar to other parts of the world?
Some elements are very similar, so tight labour market, deteriorating housing market, stagnating GDP. But we have had a confluence of other things in the UK, the shortage of workers exacerbated by Brexit and other things. Inflation here in the UK still double digits despite the decline. Core inflation is coming off, but again, still very high from very high levels.
So how do you think that the BOE is looking at this? I know, and I've taken a bet, I won't say which way I've taken a bet, but the March 23rd hike is now in question.
Yeah, so I think that one's going to be quite a close call. So the signal we got from the last meeting was that Bank of England's probably done. They were going to be hyper data sensitive. The wage numbers we had yesterday are definitely pushing towards a rate hike is necessary. Today's numbers will be a relief, and I think that's where there's probably going to be quite intense debate on the Bank of England for the rate hike. But more importantly, at the end of the year, I think it's going to be very difficult to see cuts. I mean, in the US, if they carry on hiking for longer, it just narrows the window for that about turn in policy. And in the UK, we think core inflation is going to be so much higher for longer that the Bank of England won't be able to cut, even though after today's numbers, the market's starting to price in a bit more of that. We think it's unlikely.
Well, it was interesting last time where we're at the Bank of England to hear them, I guess, move away a bit from the doomsday scenario, but actually it's going to take a long time for any kind of meaningful growth to come back.
Yeah, it is. And the other part of the Bank of England's assessment, which I thought was really important, is what they're saying about potential growth. So we think, and we agree, that potential growth in the UK is going to be 1%, at best. Yeah. It just means you have to have an even bigger downturn in the economy to squeeze inflation out. And so, yes, in the near term, we've had some better data, labour market's holding up, but the medium-term assessment is very bleak, and actually we would concur with that.
Hedda, what are you expecting from ECB?
ECB, I mean, they've pre-committed, haven't they? Again, despite no forward guidance, they've told us, with some certainty what they're going to do. So I think, next meeting, it's a 50. Thereafter, I think 25, most likely. There's definitely a kind of looking in the rearview mirror, looking at what the Fed's saying, going on, I think. But yeah, the inflation problem in Europe, similar in the sense that the energy price shock is still keeping those second round effects going. Maybe less tight in terms of the labour market there, but similar problems.
Hedda, thank you so much. Hedda Mehta there, Senior European Economist at Legal and General Investment Management. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Lufthansa says issues with computer systems are leading to widespread flight cancellations this morning. The German airline has told us it's investigating the matter. Now, Chinese stocks have become a must-have for hedge funds again. The latest 13F filings show they loaded up on the shares last quarter as Beijing abandoned its COVID-0 policy. Meanwhile, Warren Buffett's Berkshire Hathaway reported an unusually quick reversal in its TSMC position. The legendary investor slashed his holdings of the Taiwanese chip giant just months after disclosing he had actually bought a major stake. Louis Vuitton has named music producer Pharrell Williams as its new menswear designer, filling a role previously held by the late Virgil Abloh. The French brand says Williams will unveil his debut collection at the Paris Men's Fashion Week. That's happening in June. Abloh was Louis Vuitton's star menswear designer before his death from cancer at the age of 41. ASML says a former employee in China misappropriated data about its technology, potentially violating export controls. The Dutch company, the leading maker of high-tech machines, license for producing chips, says it reported the breach to authorities and initiated an internal review. It's the second time in as many years that ASML has leveled charges against Chinese entities. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thanks so much. Coming up, as a fallout from the Adani crisis continues, we take a look at just how intertwined the group is with India's economy. That's coming up next, and this is Bloomberg.
The best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Earnings season continues.
The chips are down.
Earnings coming in fast and thick.
A slew of bank earnings this morning.
Bloomberg breaks the numbers first.
Numbers coming through from Shell.
LVMH numbers are hitting the tape right now.
We had a very good set of numbers in the fourth quarter.
We feel confident with the guidance we've given.
The situation has changed completely.
With exclusive expert analysis.
Europe's most valuable company.
Trending towards the higher end of its historical range.
That can continue. How do I play this into 2023?
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Now, if you are traveling, I cannot say this enough, Lufthansa says its IT systems have issues and they are causing widespread cancellations. So if you are traveling, check with your airport or travel agent before you show up to the airport. Lufthansa just about 15 minutes ago saying the company computer systems are leading to some of widespread flight cancellations. Today, the company, we understand from a spokesperson, is investigating the matter. So that's all we know at the moment. Again, it will cause disruption for travelers across Europe. Lufthansa share price currently down 2%. Now, the rise and fall of Adani has demonstrated just how intertwined the company is with India's economy. But business groups want the rest of the world to know India is much bigger than the conglomerate.
Yes, solar. Adani solar.
From the rooftop of this house in Shiracha village, Adani dominates the Gujarat skyline.
Other than one Tata facility, the rest is all Adani.
In 2010, there were 3 public-listed Adani companies. Now there are 7 and another 5 in queue. In the last decade, Adani became India's fastest-growing infrastructure conglomerate, with 1/3 of the country's port capacity to the largest piped gas license area.
Those are one-class
infrastructure investments. You know, they are very large percentage of the domestic market in terms of capacity and capabilities.
The India infrastructure story is littered with fallen fortunes due to heavy debt financing, delays, bureaucracy, and corruption. Credit Suisse red-flagged the Adani Group and 9 others in its prophetic House of Debt report in 2012. Many on that list have since struggled, but Gautam Adani seemed unstoppable. Friends in high places, a debt-fueled empire, concentrated shareholdings, mysterious investors, and a meteoric gain in Adani's share prices, adding to his controversial rise. Till Hindenburg Research struck and scuppered his plan to use high-priced equity to repay debt.
The lesson for everyone is that we should believe in top-class corporate governance, and we should be willing to open our records to everyone in the world. And I'm quite sure that Adani's will also bounce back in due course.
Foreign lenders that hold close to half the Adani debt are less confident. At least one Adani partner is reviewing future investments, and there's fear this may hurt foreign interest in Indian infrastructure, manufacturing, and green energy.
I think India is a big country with a number of companies, and infrastructure investments in India is a huge opportunity. And I think foreign and international capital providers recognize that.
India is not just Adani defends a Modi government facing political protests and allegations of crony capitalism. That's partly right. Despite the high debt and still high market capitalization, the Adani Group scandal has so far had no contagion effect, though it has prompted a social media wave of nationalistic messages supporting Adani and Indian enterprise. Meanwhile, in Sriracha, Vishal rues the lack of formal jobs in the region, while counting a 6,000 rupee loss on Adani's share investments. In Gujarat, Menaka Doshi, Bloomberg News.
Coming up, we'll take a look at some of this morning's biggest stock moves from banks to luxury. This is Bloomberg. Amazon acquired Zoox back in January 2020 for what reports suggested was $1.2 billion. Since then, the company has revealed its Zoox vehicle. This is, I think, a rectangular passenger-focused vehicle with no driver's seat or steering wheel. How would you describe it?
We describe it as a purpose-built vehicle, but it's really a robo-taxi. That's its purpose. And essentially, it's about transporting people from point A to point B on demand in the most effective, cleanest, and most enjoyable way.
So why won't you call it a car?
Because a car is, there's an inference that there is a driver. Whereas in our robotaxi, there is no manual driving. A human cannot really drive it to transport passengers. So we want to make sure that that mindset, that shift, that distinction is clear.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition of Francine Lacqua here in London. Now, let's wrap some of the big stock news out of Europe this morning. Louis Vuitton, LVMH's biggest brand, has named music producer Pharrell Williams as its new menswear designer. Now, meanwhile, revenue of luxury goods maker Kering plunged. Supply disruptions in China hurt Gucci sales, and ad controversy hit Balenciaga. And then Barclays, on the banking front, missed estimates for both fixed income and equities trading. The bank did, though, announce a fresh share buyback of as much as £500 million. So joining us for more on this, Bloomberg's Tom Metcalf, who's going to talk luxury, and Bloomberg opinion columnist Andrea Felstead, who's going to talk banks. I'm kidding, guys. Calm down. Andrea, let's talk luxury. You write some beautiful opinion pieces, right, on luxury. And there are two things. First of all, if you look at Kering, it was pretty dismal, actually. Gucci was, not as good as expected, and then they had that whole Balenciaga story.
Clearly, there needs to be improvement at Gucci. They have appointed a new designer. Everybody is waiting for him to, really come out with his new designs. It really needs to be rejuvenated, a shot of energy into its fashions, which consumers have got a bit bored with the big logos and the bold colors, the maximalism.
Okay, so talking about LVMH, this was huge news, right? It was announced yesterday, and this is Louis Vuitton, really the cash cow of LVMH, with a new chief executive appointing a new designer.
Exactly. Surprising, again, like the Gucci appointment. Sadly, Virgil Abloh died, and they had to find a replacement. It seems they have almost sought to replace Virgil Abloh as much as possible. History of music, streetwear, ability to collaborate. But when Virgil Abloh was appointed, it felt very new and fresh. Pharrell Williams feels like, obviously he's been around a long time, he's been associated with luxury a long time, strong pedigree, but it really feels like a safe pair of hands rather than something very new and exciting. And will that be exciting enough for consumers? Everybody talks about heritage with luxury, but it's really the constant newness that makes you want to go out and spend a lot of money on a handbag or a pair of sneakers. It needs that constant energy. So that is the question. Will this be sufficiently different and have enough energy to propel those new sales?
I mean, this is exactly what Tom was thinking on that new Gucci handbag. He was thinking, is this exciting enough? Do I go for Gucci or Louis Vuitton?
It's the big question.
It is a big question. Just to go back on what we can expect from Pharrell Williams, is this all about collabs? Do they make money? Or, how big is the Louis Vuitton group in general?
Well, Louis Vuitton, in general, is about 20 billion euros of annual sales. It's the biggest brand in the LVMH stable, and it's really the driver of the fortune. So that has to keep motoring on to keep LVMH going in the right direction.
Okay, nothing like talking about luxury. The newsroom, the producers are saying, wait, I'd rather Chanel. Tom, thank you for your great luxury contribution. If you look at Barclays, I'm quite surprised. I know they didn't really, there's nothing good in the results, but their share price is down almost 8%.
Yeah, I think I just saw it come up on the screen more than at 8.5 now, so really getting dinged. And I think that's the problem, is it's across the board, right? It wasn't just a bad quarter for the investment bank. They kind of missed estimates right across the board. And you mentioned that £500 million buyback. Even that isn't enough. A lot of analysts are saying that was a bit disappointing. We've seen rivals pay out a lot more. And, I think it's just that sense that right across the bank, there wasn't sort of any standout performance.
So what does that mean for how they need to re-strategize going forward? Again, is it because they didn't excel in giving back? They have still $500 million in dividends. Could they have done more?
Yeah, I think, as the CEO, Venkat, was saying, it's kind of a unique year because they had those two sort of spectacular flubs, one on the paperwork blow up and one obviously on WhatsApp. And as part of that, they actually dinged their bonus pool by about £500 million. And what Venkat was saying, along with other executives, was like, look, this is a one-off. We're doing everything we can to make sure this never happens again. And if you can strip those out, the bank is in good health.
Is there anything else that we should be looking out for? So there's also the bonus pool at Barclays with a lot of the cuts to a lot of senior management. What happens to Barclays in the next 2 to 3 months?
Well, it's really interesting, right? For the last few quarters, it's been a really positive story around that massive investment bank they have. And this is the first quarter in a while that it hasn't quite sort of delivered and almost acted as ballast for the rest of the bank. So I think it's, they're set on this strategy. It has worked in very recent quarters. Yeah. And I think they're just hoping for a rebound next quarter.
You know why we got you together? Talk about banking luxury, but also really talk China. How's China sales doing? This was it was interesting to see that Kering didn't manage to make up for that slowdown in China, but LVMH and Richemont did.
China had a terrible, the fourth quarter was terrible for China. The hope now is that consumers come out and start spending again. That will be the biggest driver for luxury this year. The US has really powered the industry for the last couple of years, but there are signs that's slowing. They really need China to pick up that bling baton to keep them going through this year.
But Andrea, if you look at margins, I mean, the luxury, I mean, banks dream of these kind of margins, right?
Yeah.
Because they've just, I mean, I think Chanel was hiking prices by 30%. Like, how much longer can they do this kind of hike?
This is the question. I think if the Chinese consumer comes back, they can probably keep hiking. If it's down to domestic consumers, particularly the US, where there are pressures, particularly on that sort of the lower tier luxury consumer. They're suffering from inflation, high costs like everybody else. There is a point where they won't physically or metaphorically wear higher prices.
I mean, wouldn't it be fun to swap like the chief executives from a bank to a luxury company and vice versa? Tom, what's the biggest concern for a lot of the banks? And you see clear winners and losers, right? In a rising interest rate environment, like what are you looking for?
Yeah, I think it's those expanding margins, right? And across the UK banks, which are all coming out over the next few days, it'll be really interesting to see if anyone's able to sort of really sort of push their profit margins further. That's what a lot of investors were thinking about. But actually, when you look at the results today, it's not been a massive improvement. So it's that outlook and, of course, kind of any sort of thing around bonuses and job cuts.
All right, thank you both for joining us for a spirited conversation on two interesting industry groups. Tom Metcalf covering banking, our Bloomberg Opinions, Andrea Felstead, who covers luxury. Now, we're also getting some breaking news, and this happened about 20 minutes ago. Deutsche Lufthansa is saying that they had issue with some of their company computer systems, and that's leading to widespread flight cancellations today. Now, we understand, we hit the phones, we spoke to the spokesperson of the German airline by phone, and she said the company is investigating the matter. So we don't have that much news. On the back of it, share price is down 1.8%. If you need to go to the airport, if you're flying to or from anywhere, just check with your airline or call the airport ahead of that to make sure that you don't get stranded at the airport for hours like sometimes it happens. The picture overall for markets is one of cautious optimism. We do look at the inflation boogeyman, what that means for inflation services. We had US inflation yesterday, we had UK inflation today. And then the other big story is, for example, Glencore paying out some $7.1 billion. This is thanks to coal. It'll be interesting over the next couple of weeks and months to see what a lot of ESG-conscious shareholders do with Glencore. Now, that's it for Bloomberg Surveillance Early Edition. It continues in the next hour with Matt Miller in New York, Anna Edwards in London, and this is Bloomberg.
Successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a, started out a consumer company. We're thick in research. we got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Inflation is still too high.
Inflation's still here. The economy is still strong. And I think they have to decide how to play it.
The most likely scenario, and I give it 50%, is that we end up with sticky inflation, 3 to 4%.
I am confident that the gears of monetary policy will continue to move in a way that will bring inflation down to 2%. We will stay the course until our job is done.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. CPI aftermath, investors digest US and UK inflation data and the likelihood of interest rates staying higher for longer. Following the big money, Warren Buffett sends an ominous signal on TSMC, while Sam Druckenmiller ditches tech stocks. And Elon Musk says he may need the rest of this year to make Twitter financially healthy before handing it off to a new CEO. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And Matt, the markets took quite a while and actually came to different conclusions based on different asset classes as to what it meant, that CPI print yesterday. It's already, well, it seems to still be something that the market is having to think about and digest, adding to that other global inflation around the stickiness of inflation.
Yeah, absolutely. And not just different asset classes, but different industry groups, right? Because yesterday in the cash trade here in the U.S., we had the NASDAQ closing higher, more than 0.5% higher, while the S&P 500 was unchanged and the Dow finished down. So I guess it depends on what kind of stock you are, growth versus value, maybe big company versus small company, tech stock versus car maker, determines how you did with that inflation print yesterday. Take a look at what we're seeing today. S&P futures are off about 1/3%. Now we closed just about here in the cash trade, 41, I want to say 41.35, 41.36. So still 15, 16% higher than the October lows. The rally, I guess, is alive and well. The U.S. 10-year yield coming down just a bit, but it's higher than it was at this point yesterday. So when we looked at it yesterday, it was at, I think, 369 and change. We're about 3 basis points higher than that, and that is a bit of a headwind for stocks, right? When you get a higher yield from zero risk assets than you do stocks, you tend to want to get into those. The U.S. dollar index climbing back up a little bit higher today, and we see it higher against, I'll show the yen in a second, but also the pound and the euro at 1239.20 on the U.S. dollar index. And then NYMEX crude down now $1.11, so not as bad as it was just about a half hour ago. We were down almost 2% on West Texas Intermediate, but still continuing to fall because this is really a telltale sign of the concern that investors have for global growth. If we don't see it, you won't see the demand, and as a result, you have lower prices across the oil complex. In terms of the Asian finish, overnight we had the MSCI Asia Pacific down about 1.2%, and the Hang Seng, one of the biggest losers, off 1.5%. You can see the Nikkei didn't do nearly as poorly, down about 0.4% in Japan, and there you see the U.S. dollar showing some strength at the yen. You can now buy 133.3 yen for $1 US. What do you see in Europe now as far as reaction, I guess, to not only the inflation story here that we saw here yesterday, but also that you have in the UK?
Yeah, absolutely. So we had the inflation print mid-session yesterday from the US perspective, mid-session here in Europe then, Matt. So we had some time to factor that in, but we continue to think about where the inflation story gets us. And I'll come to the UK side of things in just a moment. This is what we have on European stocks right now. A real divergent performance across a number of sectors. So if you're really exposed to real estate or to basic resources, then you're not doing so well. So the London market is fairly flat today. If you're really exposed to the consumer and to grocery stores and to some of the luxury names, then you're not doing too badly, up by 0.9% over in the CAC 40. And actually the names in the grocery section, such as Ahold Delhaize and Carrefour, doing really well on better than anticipated results in the grocery space. That's what we're seeing across the map. This is one of the big names in Paris, of course, doing well today in the luxury space, up by 3.9% on Kering, bouncing. They had a sales slump in China, but it does seem as if investors are choosing to look through that sales slump, also looking through the difficulties they had with one of their ad campaigns related to the Balenciaga brand, which they have said has had an impact on the business, but investors choosing to look through both of those things and send the share price a little bit higher, focusing on the reopening story, it seems, in China, which looks more positive. Barclays down by 8.7% for this UK bank, of course, with a substantial investment banking presence. And really, they disappointed across the board. When it came to the numbers, all kinds of numbers that the market estimates, the numbers actually came in worse than that. And even though they introduced a buyback, it was seen as fairly small compared to some people's expectations. So Barclays down 8.7%. Glencore in the mining space, fairly flat right now. We heard from them around their coal and trading business. They've seen record profits at the company, driven by the trading business, the coal business, all of that doing very nicely for them. And returning cash to shareholders, certainly a theme when it comes to this particular business. They were going to be returning more than $7 billion in dividends and buybacks to investors. And this is the pound, 120.91. It is quite weak today, down by 0.7%. But this actually to do with the inflation print here in the UK. So we've had this inflation number came in at 10.1%. That wasn't at 10.3, which had been estimated. So it's still, of course, ludicrously high by anybody's estimates, estimation, but it isn't as high as had been expected. More on that with Valerie Teitel shortly. And I just wanted to mention a red headline across the Bloomberg in the last few minutes. Scotland's Nicola Sturgeon, this is according to BBC reports, I should say, only that source at the moment, is to resign as First Minister of Scotland. She a leading light, of course, in the Scottish independence campaign. No doubt that continues, whether she is there or not. We'll wait for any confirmation around her future plans, and the pound is pretty unmoved right now by that news, Matt.
All right. Any reason as to why? Has she had enough?
Well, we'll look for further details. We'll actually look to see whether this is the case. I mean, it is, as I say, just one report at the moment. There's been there's been criticism of the way she's mixed handling of Scottish independence with certain other domestic social issues. Culture wars have been in the mix as well, and so whether that has some bearing on it, we'll see.
All right. Interesting indeed. Let's get back, though, to the big inflation story after the CPI in the U.S. rose briskly yesterday, with the annual headline rate and core measures both coming in hotter than expected. Richmond Fed President Tom Barkin spoke exclusively with us here at Bloomberg Television after the report.
We may or may not choose to take rates up further if inflation continues to persist, but we'll have to see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists at levels well above our target, maybe we'll have to do more.
Valerie Teitel has been tracking the market response, and Valerie, as Anna said earlier, it's been a bit up and down in terms of how markets are receiving this information and looking at it.
Yeah, definitely, Matt, especially right after that number came out. I mean, the swing was wild. It ended up, two-year yields almost rallied 10 basis points right after that number came out. But as the day went on, the yields tracked higher. In fact, if we look at how the two-year yield has moved since that hot payroll reprint on February 3rd, it's risen nearly 50 basis points. In fact,
a fun fact about this, the S&P over that same time frame is in the green. It's just been quite a confusing market for someone to figure out, but I want to dive a little bit deeper into what's been going in the front end. If we look at the euro-dollar curve, which is front end rates and how they've traded since that hot payroll print, the curve has shifted up and out, meaning the peak rate is now seen later in the year and at a higher level. In fact, the markets are now pricing even odds that we could get a hike in June. That would take the Fed funds rate to 5.5.
Right, indeed. So that's the way that the US conversation is shifting. What about the UK dynamic then, Valerie? This is an interesting one. We've seen gilt yields reacting to this. We've seen the pound reacting to this. A reassessment of the extent to which we get hikes from the Bank of England as a result of CPI that's still really high, but came in below estimate.
Yeah, I think the Fed might be jealous of this report out of the UK today. It was broadly soft, that was across headline and core. And there was a sharp fall in services inflation, which is going to be a welcome sign for the Bank of England, Anna. This comes after we had a hot wage inflation data yesterday that was in their unemployment release in the UK. So it's a good sign for the Bank of England after that worrying wage inflation data yesterday. And in fact, we have seen two-year yields take it in stride, rallying almost 13 basis points since this print. I want to note that they were dragged higher yesterday given the sell-off in the U.S. front end, but they seem to be taking this report in stride, and cable is lower in sympathy.
All right, Valerie, thanks very much. Bloomberg's Valerie Teitel there walking us through the inflation data on both sides of the Atlantic. Now let's get to a U.S., I guess Western world versus China story. Dutch chipmaker ASML says a former employee in China stole data about its proprietary technology and that export controls may have been violated. Joining us now for more is Bloomberg's April Roach in Amsterdam. So April, with tensions between the West and China at a heightened level, this is not great news. What do we know about the alleged misappropriation of data?
Yes, so as you said, ASML said a now former employee in China stole data about its proprietary technology. The semiconductor equipment maker said it is investigating the misappropriation of confidential information and that it has informed the relevant authorities. And ASML made these comments in its annual statement where it highlighted that it has seen increasing security risk trends such as phishing attacks and attempts to steal its intellectual property, and also said that this incident may have violated certain export control regulations.
And what is the impact on ASML's business then from all of that?
So currently there's not much known about the incident. There's still a lot of uncertainty surrounding the details. And ASML said it did not make an earlier statement about this incident because it does not see a material impact on its business from what happened. However, the fact that it did highlight that certain export control regulations may have been violated suggests that this could perhaps be more severe than what we expect. It's also good to note that this is not the first time that ASML has leveled charges against Chinese entities. Last year, it accused a Beijing-based firm of attempting to steal trade secrets.
All right, April, thanks very much. April Roach covers ASML for us out of Amsterdam, walking us through the details of that story. Now, the latest 13F filings show Warren Buffett's Berkshire Hathaway reported an unusually quick reversal in his TSMC position. The legendary investor slashed his holding of the Taiwanese chip giant just months after disclosing he'd bought a major stake. Bloomberg's Kriti Gupta comes in early and gives us the details of these 13F filings. Kriti, what do we know?
Yeah, just for you, Matt. This is a really important story when it comes to
Warren Buffett. That sounded sarcastic.
I mean, well, it's really for Anna. Let's be completely honest. But I guess we'll rope you in as well. Let's talk about Warren Buffett here. Look, he's a long-term investor. We know he makes these really big kind of stakes on things like Coca-Cola, railroads, most recently Occidental, and his big call on oil right now. He made a call on TSMC only back in November with a stake of about $5 billion. And apparently sold it fairly quickly too, Matt, as you pointed out. If you look at the average price over the period, the stake sale would have been about $3.7 billion. But context is everything here. So even though on the surface it looks like it is a loss, it's really important to keep in mind what the chip makers have really done, especially in that in December when you did have a lot of the kind of geopolitics of the chip sector really come to the forefront. It wasn't just Warren Buffett that actually pulled out of the entire chips index. A lot of this has to do with the fund flows that you saw out of semiconductors broadly, and this really comes down once again to geopolitics. Remember, in the last couple of months, in the fourth quarter specifically, you did actually have President Biden introduce a lot more plants that were going to become more operational here in the States when it comes to chip making capacity. Also working with the likes of Japan and the Netherlands, as you pointed out, with ASML, and working on what those chip exports actually look like. And that has created a little bit of a spooking factor for a lot of investors who were actually pretty deep into the semiconductor space purely on the idea that chips are in everything, and that's an inflationary bet.
And Chrissy, good morning to you. Thank you very much for coming in to talk to us about these stories. And let me ask you about Stan Druckenmiller and the Duquesne family office, because we've also seen an exit from certain tech names there.
We have, and you know, it's interesting, when we talk about chip stocks, it kind of feels like the one big heavyweight you have to watch is NVIDIA. So I'm gonna start there. When we talk about what Druckenmiller actually bet on, this massive bet on NVIDIA, about 4% of his entire $2 billion portfolio is now just in this one company. And remember, this is the heavyweight, which I should mention in the last week or so has actually been leading a lot of the tech gains right next to Tesla. So this is kind of a story not only on the EV side of things that you're getting a lot of government spending and government kind of incentives on, but also on the idea of ChatGPT, AI intelligence, data warehouses. If you're a believer in kind of this innovation and innovative technology, think the metaverse, for example, AI, whatever you want to rope into that, NVIDIA has been kind of at the heart of it as they look to diversify their own business. So that's been a major bet. But on the other hand, they have exited a lot of some of the major companies. Think Microsoft, think Amazon, and they're kind of the only ones to do so, because in the last quarter, when Druckenmiller, exited those companies, you did have the likes of Lone Pine upping their stake of Microsoft by about 23%. It's now the fourth biggest holding for Tiger Global, and even Amazon, Baupost Group tripled their stake. So it kind of feels like Druckenmiller's going against the curve here.
So family offices basically out of the tech trade,
right.
Hedge funds in, but Druckenmiller still with the big win on NVIDIA, because that has almost doubled from its, no, it's more than doubled from its October lows. If I look, the low at 111, and now it's at 229.
Exactly.
Kriti, thank you very much. Kriti Gupta there with some of the details on the 13Fs. Take a look at some of the stocks we're watching in the pre-market today. Airbnb beat estimates with its outlook for revenue in the first quarter. That signals travel demand remains robust, even after the record year for growth in the post-COVID 2022. Airbnb said sales could reach $1.82 billion in the 3 months ending March, and that easily clears analysts' average estimates of $1.68 billion. Let's take a look also at Devon Energy. Shares fell in the post-market and now are down in the pre-market almost 7%. The oil producer reported fourth quarter core EPS that fell short of the average analyst estimate. The company also said CapEx will be more than $3.6 billion, could be $3.8 billion, and analysts are expecting spending of $3.4 billion. So costs need to be kept under control, says Wall Street. Ford, which is keeping costs under control. Remember yesterday they said 3,800 people are gone across Europe. Now they have temporarily halted production and stopped shipments of the hot-selling F-150 Lightning electric pickup truck. There's an unidentified problem with the battery. The automaker confirmed Tuesday that it stopped building the plug-in pickup at its factory in Dearborn. And even if those shipments are underway, for example, if your Lightning that you ordered is on the way to the dealer, you won't be able to pick it up. So I know how bad that is, waiting for your truck. It's a big bummer. But the problems continue.
You have a lot of empathy for those in that situation, yes. I can feel, Matt. Right, coming up on the program, back to the macro conversation. Freya Beamish joins us, T.S. Lombard, chief economist. What kind of recession does she see in the United States? What kind of reopening in China? We'll also talk about Musk as he gives himself the year. The Twitter CEO says he'll be handing over the reins by the end of 2023. More details ahead. This is Bloomberg.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Surveillance Early Edition. I'm Matt Miller here in New York with Anna Edwards in London. And after yesterday's CPI data, the market went on a bit of a roller coaster ride. First up and then down. We closed unfinished or unchanged, I should say, on the S&P, but now futures are looking down again. Investors just can't really make up their minds as to what this means for the central banks in terms of hikes. I've got a chart here that's just about as confusing as investors are confused about this data. Joining us now is Noor Al-Ali, Bloomberg Markets Live editor, to help us understand what's going to happen. So, Noor, it's really weird that the market just continues to fight the Fed, and I'm not sure if they've changed their mind or not.
Yeah, absolutely, Matt. You're absolutely correct in that it is confusing. It is a great time of uncertainty right now, and that means a lot of volatility. We've had, inflation apparently peak in the U.S. You've seen the headline print come in, and it was very supportive of, the narrative that the Fed could pivot. But also, if you look deeper in, you'll see that inflation is perhaps far more entrenched than what we'd like. We've seen shelter, we've seen food prices, really big contributors to the CPI print yesterday. Now, also, we had inflation out of the UK today also show that perhaps it would have peaked, and now we're talking about whether or not this is supportive of the BOE pivot. But also, in the same time, you had wages data yesterday show that perhaps inflation is going to be a lot more sticky, or, the concerns of sticky inflation there would be a bit of a concern for markets. And in that confusion, we've got markets weighing in.
And good morning to you, Noor. It's really interesting to look at what is driving inflation in the United States and what is not. And I know our colleague on the Markets Live blog, Simon Wise, wrote a really interesting piece about the sort of domestically driven inflation, which he says isn't coming down, but the internationally driven inflation, which is coming down. And a lot of that has to do with China. And so if China's reopening, that leads you to wondering whether we could be due another uptick in inflation. As you say, so many uncertainties in the outlook.
Absolutely. And you mentioned China because China is the big unknown right now. It is reopening. We see the M1 money supply showing, money growth broadly rising, and that shows us that, in fact, there is spending, and that's going to contribute to, higher production and higher demand out of China, one of the biggest buyers of commodities and consumers in the world. And we still don't see that, that lag in data is going to start trickling through. And that could be another spike in inflation that's not really currently being priced in right now. And the question is, are markets becoming too complacent now, looking at it data by data and thinking, yes, okay, it's peaked. No, it hasn't. Yes, yes, the Fed is going to raise rates by 50 or whatnot, or they're going to pivot. And I think that's the concern that's happening here.
Okay, Noor, thank you very much. Thanks for your time. Noor Al-Ali of Bloomberg Markets Live. Remember, you can get further market analysis. Check out the Markets Live blog. MLIV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
So many people recognize you because you have a very famous hairdo that I've asked you about before. But to some people, they may say, well, Ken, what happened? Where did that hairdo come from and where has it gone? Because right now it seems a little different than what I've seen before.
Yeah, it's growing out a little bit, David, but COVID, you know, I ended up with hair going back down to my shoulder, and I finally realized that one of the things I had to do, I'm a very loyal person, and I used to have hair down to my waist in my college and my hippie days before that in Ann Arbor, Michigan, and I had it cut off in the summer of '75, and I've gone to the same person, now a grandmother many times over, who was a young gal cutting hair in Amherst, Massachusetts, and I still seek her out, and I finally just said to her, you know, COVID's enough of a change that I ought to be able to do something new.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Now keeping you up to date with news from around the world, here's the first word. The U.S. says 3 unidentified objects shot down by the military since last Friday were not used for spying, but likely tied to some commercial purpose. Signs are emerging that both the U.S. and China are trying to figure out a way past the balloon dispute. Secretary of State Antony Blinken is said to be considering a meeting with his Chinese counterpart in Germany this week. Speaking of Germany, Lufthansa has grounded all of its flights because of company computer issues. A spokesman says the company is urgently investigating the matter. It wasn't immediately clear whether Lufthansa flights were already airborne, were instructed to land or not. In total, the group operates around 700 aircraft, making it Europe's largest airline by fleet size. Coming up, Freya Beamish, T.S. Lombard, chief economist, joins us to help interpret the inflation data. This is Bloomberg.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a
price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Politics to the world of business. Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. CPI aftermath. Investors digest US and UK inflation data and the likelihood of interest rates staying higher for longer. Following the big money, Warren Buffett sends an ominous signal on TSMC while Stan Druckenmiller ditches tech stocks. And Elon Musk says he may need the rest of this year to make Twitter financially healthy before handing it over to a new CEO. I'm Anna Edwards in London with Matt Miller in New York. And Matt, it seemed that equity markets yesterday were trying their best to look on the bright side when it came to that inflation print and what that might mean for Fed policy. Today, though, not so much.
Yeah, absolutely. I mean, we even rallied into that number. So we're now at 15, 16% from the October lows. And we haven't really let much air out of that rally, even after we got the Fed talk yesterday. 4 Fed speakers, at least by my count, saying we may have to see further hikes, a higher terminal rate. So right now we're looking at S&P futures that are down about 0.4%. So a little bit of air let out of that. But you can see yields at 373 offer a pretty good competition to S&P yields. So another headwind here, and the Bloomberg Dollar Index rising, which adds more pressure to a sell-off at the open this morning in just about 4 hours from now. NYMEX crude also down $1.15. It had been down a little bit more, almost 2% earlier, but we see oil across the spectrum down this morning, whether you're talking about Brent or West Texas Intermediate, as concerns persist about the global growth situation. We also see a lot of individual stock stories today. Airbnb won on the positive side. It beat estimates with its outlook for revenue in the first quarter, signaling travel demand remains robust even after a record year for growth in 2022. So that continues, and I know you've got a lot of good news for the most part about consumer stocks over there as well. Devon Energy here, those shares fell yesterday in the post-market. They're down in the pre-market as well, 7% right now after the oil maker reported fourth quarter core EPS that fell short of the average analyst estimate and says spending's going to be higher. CapEx will be between 3.6 and 3.8 billion. Analyst estimate was for 3.4 billion, and that's a concern, obviously, for investors. Ford, which yesterday said it's going to cut 3,800 jobs across Europe in its shift to EVs, now says that it stopped shipments of its hot-selling EV pickup truck, the F-150 Lightning. There's an unidentified problem with the battery, and even if they're on the way to the dealer and you've ordered one, you're not going to be able to pick it up until they figure that out. Anna, what do you see in terms of the European trade?
Well, the strength we saw earlier on, Matt, in European trade fading just a little bit. We're up, but only by 0.1%, so pretty flat, really, across the European equity market space. Still digesting that inflation data of yesterday. We've had some strong reports coming out of some grocery businesses, Ahold Delhaize, Carrefour, and the like, all on the rise, quite substantially, actually, because of the performance that they've delivered. But some of the early gains, as I say, for European stocks have been fading. Barclays is one of the negatives today, down by just shy of 10%, in fact. This is the business reports numbers for the last last quarter that seemed to show it missed estimates across the board, across a whole range of metrics, from fixed income trading to equities trading to other metrics that the analyst community look at. It seemed as if there was a lot of room for disappointment. And even though they announced a buyback, it wasn't necessarily higher than had been expected or even in line. Glencore, on the other hand, $7 billion worth, more than $7 billion worth of money being returned to shareholders in dividends and in buybacks. So that's part of the story there. This is a business, of course, that's been doing very well off its trading arm, in particular trading coal. The pound is at 120.90, and this really, the move is very much attached to the inflation data we had out earlier on today. It came in at 10.1%. The estimate was for 10.3%, and it's a drop down from 10.5% the previous month. So it's still double digits, still really high inflation, but it's not as high as had been expected. And so expectations around the BOE just shifting a little bit. We're also watching domestic politics. The First Minister in Scotland, then, Matt, has called a press conference for the top of the next hour, and the domestic media reporting here in the UK that this is because she plans to resign. She's under quite a lot of pressure at the moment because her party, the SNP, has been fading in the polls of late.
Right, and she's been in there for, what, already about 9 years, I believe. So
yeah,
it's been a long run for Nicola Sturgeon. We look forward to the press conference to find out exactly the details of what's happening. Let's get back, though, to the economy. Joining us now is Freya Beamish, chief economist at TS Lombard. And Freya, we're all trying to figure out, I think, you know, why the markets continue to rally in some senses, right? We're still up 15% from the October lows, even though there are increasing signs that the Fed's going to have to raise rates further and hold them high for longer. What's your view?
I think what the equity market is worried about at this stage is recession, and that we're going to continue to see earnings downgrades on the back of weaker growth. And I do actually think that we could get some more scares in that direction. But sort of taking a step back here, I think in a sense what the Fed is doing is quite sensible, and I think markets in a way they sort of see that. So what the Fed is doing is that they're recognizing that there's all of these different shocks that are being digested, different cycles that are in play, and they're feeling their way towards a necessary slowdown. And I do think the slowdown to a degree is necessary to knock out the COVID-type distortions in inflation and to bring that process to its conclusion, digesting through the snake, if you like. But they're probably, we think the Fed is probably going to switch towards a more dovish stance as it starts to see the economy starting to rebalance. So that's code for saying they're not going to chase unemployment up towards above 4.5%. It may rise that far, but they're not going to chase it higher in order to push inflation back down in a Phillips curve type sense.
Okay, do you think there is a risk, Freya, that we see a resurgence in inflation? Is that a possibility? In particular, you know, you follow the Chinese reopening story very closely. Is that going to be inflationary for the rest of the world? Or maybe not, because it's about Chinese services and not about factory floor inflation?
Yeah, big picture here is that I think that inflation over the post-COVID cycle is actually going to be higher than in the 2010s, so kind of 3% or above rather than below 2%. But right now, 2023 is sort of like the year in between. We're digesting the shocks through COVID. That's passing through core goods. A bit of a shock a bit of a heat in January still in the US inflation data in core goods. But the likelihood is that if the economy slows, that will continue to see disinflation in core goods, and that will gradually feed into services as well. So we are still at the moment viewing January data as a sort of a statistical blip. But the trend in towards disinflation was nascent, and therefore we do have to be a little bit humble here. And if we step back and look at the China is one of the kind of the major shocks to the system this year. The reopening. In the first half of the year, we are expecting Chinese growth to be strong. But yes, as you say, it's much more focused on services. So it's not a normal type of Chinese reopening, either in terms of what it implies for inflation or in terms of what it implies for goods. And when I look at the leading indicators for China, the second half of the year looks much slower. Liquidity growth is just simply not there in order to support a continuation of the recovery from China.
Okay, and so when you look at the US, back to that side of things, and you expect to see a mild recession in the United States, Freya, when do you expect that to kick in with these data prints that show robustness in the labor market, even when there are cracks, or resilience in the inflation print, even when certain elements are falling? Does it make you think that perhaps the recession is being pushed out into the future? How long until we get there?
It could be. So we're very much looking out for the February and March numbers to see whether that was a statistical blip in January, and if it was, then perhaps we'll have to push it back a little bit more. But I have sort of three basic assumptions. One is that the change in interest rates, the rapidity of the change in interest rates, is enough to bring about a temporary slowing in growth. The second is that growth can slow without a major uptrend in unemployment. So there's a little bit of decoupling there between the labor market and the growth numbers. And the third is that despite unemployment perhaps not rising as much as you would expect in a recessionary environment, you still can get services inflation coming back down if the economy starts to slow. And I think the numbers looking beyond the labor market, looking at deterioration in supply and demand for credit, looking at the potential for a mild inventory cycle beginning, looking at the rise in real rates as a result of inflation coming down. There's enough in there to bring about a bit of a slowdown in the middle of the year,
Freya,
although it doesn't translate so much into the labor market.
Freya, the Fed has already raised rates by what, 450, 475 basis points, and you know, we're only down 15% in that period on the S&P 500. We've got 3.4% unemployment. Financial conditions are pretty loose, and you've got inflation still running hot. I mean, after all that, they've got nothing to show for their rate hikes. How much higher do they have to go?
I think they do have something to show for the rate hikes in terms of inflation having started to slow in terms of 3-month annualized rates. Okay, January, it goes in the opposite direction, but as I said, that seems we're at the moment still taking that as a blip rather than the trend, albeit with a bunch of humble pie because of that being a nascent trend. But I think we have the beginnings of a slowdown in inflation, and we have beyond the labor market the beginnings of the slowdown in growth numbers. Before the January, remember before that January burst in NFP, that was the narrative. And there's a lot of statistical stuff that goes on in January that we have to be careful about, sort of throwing out that entire narrative of slowing growth and inflation just based on one print. I'm perfectly prepared to eat humble pie if those statistical numbers do not start or the statistical factors do not start to reverse in February and March. And our base case is very much to the upside and has been since sort of midway through last year. We've been very, very much saying that the Fed would have the tilt here.
Thank you very much for joining us, Freya Beamish of TS Lombard. Just want to update you on one of our evolving stories, and this to do with Lufthansa. You remember earlier they grounded all their flights after a computer system failure. Well, it seems we're now getting some insight as to what caused this. Lufthansa's IT issues were caused by Deutsche Telekom cutting a cable. This coming to us, I think, from Lufthansa themselves. The Lufthansa share price recovering a little bit. The Deutsche Telekom share price, as you might expect, moving a little bit lower, but not by much as a result of that. So, coming up, Elon Musk says he needs until the end of the year to put things right at Twitter before handing it over to a new CEO. More details ahead. This is Bloomberg.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. You know, I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that, you know, peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it is causing quite a lot of anxiety, which means, you know, for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, you know, it's very different, and it's not something people have had to operate in for a long time.
News breaks. No one covers the world like Bloomberg.
Return to pragmatism is really that everybody's in line. The government, the enterprises, the people, in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Now, Elon Musk is aiming to find his successor to lead Twitter as CEO towards the end of 2023. During his speech to the World Government Summit in Dubai, Musk told the audience via video link that he needs to get Twitter to a stable position before then.
I think I need to stabilize the organization and just make sure it's in a financially healthy place. And that the product roadmap is clearly laid out. So I don't know, I'm guessing probably towards the end of this year would be good timing to find someone else to run the company, because I think it should be in a stable position around, at the end of this year.
Joining us now is Bloomberg's Alex Webb. Alex, good morning to you. So we know he famously did a Twitter poll to ask whether he should stand down or not. And so he says he's going to comply and find another CEO. What stood out in terms of, it was a wide-ranging conversation, let's say that. They covered a lot of ground. But in terms of what he said about Twitter, what stood out to you?
I mean, it sort of makes a little bit of a mockery of that poll, if we're honest. The poll was shortly before Christmas. Do you want me to stand down? 60% said they did. They probably expected the timeline to be a little bit sooner than, more than a year away.
Oh, this succession planning takes so long.
Well, exactly. Look, can you blame him? No, he's got a huge amount of money at stake. Twitter has huge capital requirements, not least to service its debt obligations. Therefore, you can see why he would want to be heavily involved in the running of the company. There are still lots of problems with that company. Those capital obligations are massive, and we've seen a huge outflow of advertisers. He needs to find a way of bringing that in. So, he touched a lot of the kind of old familiar things we've seen before, but the succession timing was really the big standout.
Well, and he gets to, as long as he's boss, he gets to manipulate the algorithm so that we all have, 50 Elon Musk tweets, totally irrelevant to whatever else we're following in our feeds. Why would he want to do that?
Yeah, so it was reported by Platformer that he encouraged, or basically made his engineers prioritize his tweets. The reporting suggested that he was discontent at the fact that Joe Biden got more engagement for his tweets in support of the Philadelphia Eagles at the Super Bowl than his did. Now, it's interesting, if you think about it a little bit more cosmically, it's actually kind of good for Tesla, because in the risks in Tesla's regular SEC filings, they say that he is able to generate a huge amount of earned media through his social media presence. If somehow he were to lose that ability, that would be detrimental to Tesla's business. So he can argue that by increasing his prominence on Twitter, he's actually helping Tesla. Now, there'll be a lot of people who might dispute that, given that there has been reporting that some people actually are stopping buying Teslas because of the nature of his social media presence. But that is an argument that you could hear made.
You said cosmically, Alex, which made me think of other things. He recently commented on the shooting down of objects in US and Canadian skies by the US Defense Department. He recently tweeted, and I assume in jest, that it was just some of his friends stopping by. And then he was asked about this today, and he says he's seen no evidence of alien technology or life, and the Pentagon has pushed back on suggestions that is what they shot down. They say it's more likely they are benign objects to do with corporate activity. He also said, though, that it would be troubling if there were no aliens, which takes us into new territory.
Well, and he's also the person in the past who said that maybe the world is a simulation, right? And so it's not completely wide left field. But ultimately, the US categorizes what it calls UAPs, unidentified aerial phenomena, into 5 categories. Clutter, which would include birds, plastic bags, other things. Weather phenomena, so ice buildup, thermal waves. Industrial and governmental things, so that might be what some of these things are. Foreign adversaries, which would be a Chinese spy balloon, if indeed it is that. And finally, other, which includes, little green men and
Santa.
And Santa, presumably. So the government actually is super interested in that 4th category, which is also why actually it wants service people, pilots in particular, to report when they see a UFO, because it gives them a better sense actually of when there's perhaps a Chinese or a Russian or someone else, some other adversary incurring into its airspace.
I mean, doesn't it follow?
Thank you.
Anna, I mean, isn't it logical, given the size and age of the universe, that there has to be alien life?
well, this is taking us into unexpected and uncharted
territory. Well, I mean, it's so big and it's so
Alex,
old.
any thoughts?
Like, how could it not be? Yeah.
Clearly,
Matt, how can we trade that?
Alex, thank you very much. Bloomberg's Alex Webb with the latest on Twitter and, well, other things. Coming up on the programme, NATO defence ministers are wrapping up a 2-day meeting where they have been assessing the latest developments from Ukraine. We'll get back to that serious business next. Live from Brussels, this is Bloomberg.
make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
The top names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane we refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Now a look at what is ahead today. Scotland's First Minister Nicola Sturgeon is holding a press conference shortly, the top of the next hour. A recent poll showed 2/3 of voters are opposed to the First Minister's plans to fight the upcoming general election as a de facto independence referendum. At 8:30 a.m. Eastern Time, ECB President Christine Lagarde discusses the central bank's 2021 annual report during a European Parliament plenary debate in Strasbourg. US retail sales, those numbers also due out at that time, and it's the second day of the NATO defence ministers meeting. We'll be hearing more from Jens Stoltenberg in the next hour or so. Bloomberg's Maria Tadeo is at the NATO defence meeting then in Brussels. Matt, she spoke exclusively with Canada's defence minister Anita Anand.
If Putin wants this war to end, all he has to do is leave Ukraine. And that is exactly what the fact of the matter is. And until that occurs, we are going to be standing strongly with our Ukrainian counterparts.
Maria Tadeo joins us now from Brussels. It looks like you're in Brussels. Maria, what are we expecting from this meeting? What are we expecting to hear from Stoltenberg?
Yeah, although I'm supposed to be on a Lufthansa flight, I'm not sure how that's going to go in the next few hours. But, you know, Matt, there is this NATO, this NATO summit, of course, now on a serious note, taking place today in Brussels. You heard it from the Canadian Defence Minister. Politically, not a lot has changed. This is a demonstration of support for Ukraine, stand with Ukraine until victory. But when you look at the situation on the battlefield, the NATO Secretary General did paint what is a stressful picture for Ukrainian troops. He said, we don't need to wait until the spring for a new offensive. A new offensive, quote, is already underway. Russia is moving thousands of troops to the east. They're willing to take a high casualty rate, which essentially what it means is that they're willing to have many soldiers die, if that's what it takes, to move the front line. And the issue is that Ukraine has to stay constantly engaged in battle. It means their troops obviously get tired. It means they don't have the time to rotate and regroup at times. But also it's a problem with the weapons and the ammunition. You burn through reserves of ammunition. We talk about the fighter jets and the tanks, but the Secretary General also said ammunition and the production, not just the ammunition you send to Ukraine, but the ability of the West to produce also for themselves. This is going to be a real issue now that needs to be tackled head on.
Yeah, absolutely. Making the stuff fast enough, certainly an issue for many countries in the supply of Ukraine and for their own defense. Now, the EU is proposing a new 11 billion euro sanctions package against Moscow, including forcing banks to report information on Russian central bank assets. Maria, what do we know?
Well, look, this is what we know from the head of the Commission. She has confirmed, and by the way, we're expecting this because the European Union wanted to send essentially what is a symbolic message to Russia with the one-year mark of the invasion. The longer you stay in Ukraine, the more painful and isolated this is going to become for the Russian economy. So we do have a new package. It's been approved or announced, I should say, broadly 11 billion euros worth of assets. They say they also target technology and some of the exports banned. They still say Russia continues to use drones coming from Iran. That is also problematic, so they target that. One of the issues they did not clarify, and this is the key, and it's a story we reported overnight, is this idea that the European Union will reach out to European banks to figure out what type of assets, frozen assets, they have belonging to the Russian central bank and also state-owned companies.
Okay, yes, we'll look for more details on that. So certainly Ursula von der Leyen talking about it. Maria, thank you very much. Maria Tadeo in Brussels. That is it for Early Edition. Surveillance is up ahead. They'll keep up the market coverage. They'll also bring you any headlines, of course, on Scottish politics as we wait to hear from the Scottish First Minister, Nicola Sturgeon. This is Bloomberg.
built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
The Fed doesn't just have to figure out how much is inflation. They have to figure out where do we put the interest rate long term.
Are there more hikes to come? How do they comment inflation? And we have seen that the Fed speak has been moving markets.
Equities and rates, they are still working in a way paired off, like teeter-tottering like they're supposed to.
The economy is not in recession and inflation is in the 3 to 4% range. You're not getting a Fed that's easing.
It feels like to me that the Fed has really almost locked in a game plan here. They want to get rates just above 5%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is Retail Sales Wednesday.
After Inflation Tuesday.
Oh, there we go. From New York City this morning. Good morning, good morning. I'm pleased you're buying into that story. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures down 1/3%. Neil Dutter of Renmac yesterday said this: forget higher for longer. We still need to get higher. TK, a lot of people jumping on board.
Yeah, it's really interesting tape yesterday. We'll go into it here. I'm going to give a shout out to Liz Young, who appears with us every once in a while. And Liz Young's got some great charts on the feed. And I'm sorry, it's a shelter sum up. And are we spending on retail sales, or can we not afford it because of rents, mortgages, homes, that? I mean, to me, it's really interesting, the linkage of Tuesday and Wednesday.
We're going to find out 8:30 Eastern time. Looking forward to that. Are we sufficiently restrictive? Deutsche Bank's Matt Lazzetti does not think so. They moved their peak rate forecast for the Federal Reserve from 5.1%, Lisa, to 5.6%. A lot of people starting to think more and more about that upside risk to the terminal rate.
Deutsche Bank has been on the higher end of the terminal rate, and now perhaps they're still on the higher end, but they're perhaps less on the higher end than they used to be in terms of other people joining with them. If you take a look at what the market is pricing in, Fed funds futures are looking at a 5.3% Fed funds peak in July, and it only comes down to about 5.1% by the end of the year. So not only are we pricing at a higher terminal rate, but also we're seemingly pricing out to some degree some of those rate cuts that people were talking about.
You were off the site yesterday, John, looking at your stock portfolio, and Lisa and I were talking with Ken Rogoff, and he is not sufficiently restrictive.
He doesn't think we are.
He is not on the edge of Bullard, but he'd been no words. Lisa, remind me, you asked the great question, and he's modeling out to 6%.
It was nuanced, because on one
hand,
he's
an academic, of course it is.
Well, no, but this is the issue, right? He's basically saying you're seeing growth surprise to the upside and inflation surprise to the upside. What do you do with that? On one hand, yes, you want to take the terminal rate higher, but what's the rush? And that was his argument. He wants to get to perhaps even 6%, but really slowly.
This is a discovery process, in the words of Matt Lazzetti at Deutsche Bank. So there's two ways of looking at it. Either you believe in long and variable lags, and you think that the cumulative tightening of the last year hasn't hit yet, or you just don't think we've done enough. Now, if you're a policymaker confronting those two risks right now, Tom, is it still the case that you think the bigger risk is doing too little versus doing too much. We spoke to the Richmond Fed president yesterday, Mike McKee, and myself, and he essentially said he thinks the risk is still doing too little.
First of all, folks, go back and look. If you're in the game, folks, go back and look at the interview, because Farrow and McKee are asking from a different world each. And it made for a really interesting bargain. I thought it was fascinating with the conservative heritage of the Richmond Fed. I don't remember, I think it was you that brought the insight out, where he said he goes out to Chamber of Commerce's and people only talk about inflation. Does Global Wall Street get that? There's really no other topic for our listeners and viewers.
Without a doubt. Does the president, does the White House get that? I think they do. I think this is the number one issue in this country still, in this economy.
Right now, this is really the threat that you start to see inflation that reaccelerates in some of the areas that you had disinflated before. If you end up with a higher than expected inflation read with several prints consecutively, we're going to start talking about a very different Fed picture.
I wanted to save this story, but I think we should do it now.
I agree.
Lufthansa is kind of the corporate story of this morning. This is Europe's biggest airline. Grounding
it's run like
flights.
As a German watch.
Grounding all flights, and we were led to believe this morning it was due to IT problems. And then we found out in the last 30 minutes, these are headlines you just don't usually read. Lufthansa IT issues were caused by Deutsche Telekom cutting a cable because they were doing construction works in the Frankfurt region. I mean, TK, that's unbelievable in 2023.
But why doesn't it happen more often? Think about the history.
Sure.
One of the first people that mentioned this to me, this is 20 years ago, was Professor Rogoff said to me, logistics in the world, the way we're all linked together, and one cable gets cut, oops.
Just getting another headline from Deutsche Telekom. They've already fixed 2 out of the 4 damaged cables. What happened to German efficiency?
Well,
What's this all
things
about?
you never want to have to say that they're working to fix damaged cables in Germany. I'm not going to weigh in on German efficiency, but this is not exactly a good PR move for either Deutsche Telekom or Lufthansa.
Lufthansa aren't great at PR. Shall I tell you my Lufthansa story? I get trapped in Frankfurt Airport for hours, maybe like 8 hours. I send them a message, complaining essentially that I'm stuck in your airport for 8 hours. Anyone who's been to Frankfurt Airport knows that Frankfurt Airport is boring. There is nothing to do. Do you know what they said back to me?
What?
We hope you enjoyed the airport. We hope you enjoyed the airport. That was Lufthansa PR.
I have a feeling that you did respond.
And did not fly Lufthansa again. Futures negative 1/3% on the S&P. To all of you who were going to fly Lufthansa this morning or through today, my thoughts are with you. Yields are unchanged on a 10-year, 373.59, euro dollar 107.19, Lisa, euro dollar negative 0.2%.
So in 2.5 hours, we do get retail sales in the United States for the month of January. How important is this going to be? Basically expected to come in a robust way. Still on an inflation-adjusted basis, what are we going to learn from this? The people do have discretionary spending. You're already seeing that in the numbers. The real questions still remain. In other words, how long is it going to take to really work down some of the excess savings from the pandemic, which a lot of people are saying still are out there. 11 a.m., former UN Ambassador Nikki Haley officially announcing, I guess. I'm not sure what the announcement was yesterday, but she's re-announcing her presidential bid in Charleston, South Carolina. A lot of discussion around whether she can win based on her demographic, the fact that she's a woman, that she's a minority. There's a lot of questions about what this will mean for within the Republican Party. But to me, the real question is the opening salvo of the contours of the Republican race will be really interesting front and center. 2 p.m., the Congressional Budget Office is issuing a budget and debt limit forecast. And Sean, I actually think this might be more interesting than it typically is, because we find out how much runway we have before we have to start really worrying about the debt ceiling.
2-year yesterday, through 460. Through 460 in yesterday's session.
Right now.
So the last time the 2-year was here, I think was back to October, November time. The last time the 2-year was here, the S&P 500 was at about 3,800. And right now it's something close to 4,100.
Yeah,
that's the disconnect at the moment, I think, for a lot of people. We've had this big repricing at the front end of the yield curve. And the equity market, even yesterday, in yesterday's session, did nothing.
We don't have time to sit on that right now, but we should explore that across the morning towards retail sales. I mean, the 2s10s at negative 87 basis points. John, I'm not on the negative 100 beeps watch. Boy, I'm getting there quickly.
Getting closer. Marvin Lowe joins us now, Senior Global Macro Strategist at State Street. Marvin, we'll talk about the data, CPI yesterday, retail sales a little bit later, but can we start with the bond market? We've had this repricing of a 2-year yield higher, much, much higher. I think the low of the year was early February, something close to 4%, now 460. At the same time, Marvin, this equity market stayed pretty resilient. What do you make of that?
Yeah, so, again, the disconnect between what bonds have been saying and what risk assets have been saying. I would add that the repricing of the 2-year also had a fairly significant repricing at the long end. So while we're inverting the curve more, we're actually doing it with higher break-evens and higher real yields. And we haven't seen that phenomena since last summer. And I think that when you get that unhinging of both inflation expectations in an environment where views are that the Fed needs to be more aggressive, you've got a cauldron coming together where risk is, should be challenged much more than what we've seen since the beginning of the year.
Marvin, what are the ramifications of the repricing, as you put it, the repricing of short paper, the LIBOR measurements, and for that matter, T-bills?
For sure, it is the market coming to the conclusion that what the Fed has been saying is an appropriate view on how the economy is going to develop, if you will, and how inflation is going to develop. We're taking out cuts while we're adding in hikes, and that's again a dynamic which a couple of months ago was one of the things that drove risk assets higher. There's new information that's coming to the market. The bond market is incorporating that into its view, but risk assets are still kind of looking towards those green shoots, which seem smaller and smaller as we kind of get this new data. And we are in an every data point matters type of environment now.
Marvin, it's so easy to say the bond market is smart and the stock market is dumb, and the stock market isn't aware of what the Fed is going to end up doing. But it's not that easy because the economy has been surprising to the upside. The facts have changed. How do you decipher how much of the rally is justified by better economic fundamentals versus the fear of what's to come from the Fed?
Yeah, you know what? There is so much data. The data is so volatile. For me, I pick the ones that, really are important in kind of this broad tightening that we're going through. And it's still inflation, front and center. We got new data, not only yesterday on that front, but we got the revisions, which really make the fourth quarter kind of disinflation, if you will, which, Chair Powell certainly talked about, nowhere near as aggressive as we had thought. So that's new data. And then, what's driving that inflation number? It really is the wage growth. It really is the jobs that are being created. And that's going to either, get affirmed with retail sales today, or, we'll have more data that gives the no landing or soft landing folks a little bit more runway. But, so far it does seem as if this hotter economy is driving consumption, which keeps the inflation discussion unbalanced.
And Marvin, given the incoming information of the last month or so, the terminal rate you have penciled in, have you put a line through it and priced it higher?
You know what? I had always thought the risk was, the risk was certainly that the market was underpricing even the dots, and we've erased that. The risk to me was always going to be potentially higher, and that this inflation story was a little bit more sticky, so that's evolving. I'm going to do it 25 basis points by 25 basis points. We are getting into restrictive territory. We are data by data dependent, and it's not as if all the data is saying that they need to go to 6%. The data is saying that it's improving so slowly that it might need to go higher. But 5.5 at this point is what I would think the Fed would signal as a new dot when they meet again in March, and then we'll go from there as the data kind of comes in.
Marvin Lowe, State Street. Marvin, great to catch up. Some of the big issues at the moment in this market. Spare a thought from Marko Kolanovic over at JP Morgan, who's had a really tough time calling this market over the last year or so. He put out some research in the last month that said risks are shifting in the direction of higher DM terminal policy rates, and he was dead on. He was right, except it hasn't inflicted much damage on the equity market at all. So you can make that call, an accurate one, on higher DM terminal rates as we price in higher DM terminal rates looking at the Fed, but ultimately it hasn't inflicted the damage on the equity market that some people might have thought.
Because it's come on the heels of faster than expected growth and positioning that perhaps left people rethinking whether they really cared about getting out of big tech, which is really the big question. Why is that rallying in the face of higher terminal rates the most? This really, that defies logic to me.
TK, two head scratchers. The rally we've seen in tech year to date, Lisa's talked about some of the reasons behind it. And number two, I still hear just a sense of confusion from Fed officials around that jobs report from 2 Fridays ago.
I totally agree with the sense of confusion about the revisions and such, but on corporate America, I'm going to go back to theme 1. They adapt, they adjust, they'll adapt to Ken Rogoff's 6% rate.
And what's the Fed? Fed's data dependent, TK.
They're massively data dependent.
Futures down 1/3 on the S&P. Gargi Chowdhury at BlackRock in the next hour. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The threat of more air and missile strikes remains across Ukraine as Russia attempts to gain full control over the Donetsk and Luhansk regions. Canada's defense minister reconfirmed NATO's support to Ukraine and called for Putin to leave the country.
If Putin wants this war to end, all he has to do is leave Ukraine. And that is exactly what the fact of the matter is. And until that occurs, we are going to be standing strongly with our Ukrainian counterparts.
Anand spoke exclusively to Bloomberg on the sidelines of NATO's defense ministers' meeting in Brussels. The UK isn't considering backdating pay raises for NHS staff and other key workers, according to a government official. The Financial Times reported Prime Minister Rishi Sunak and Chancellor of the Exchequer, Jeremy Hunt, are considering a pay offer that would see higher wages kick in from April this year, alongside a lump sum payment that would effectively backdate the pay increase to January. China warned today that it will retaliate against the U.S. over violations of its sovereignty, potentially escalating a lingering dispute just as both nations' foreign ministers plan to attend a security conference in Germany. China's foreign ministry spokesman claims the Chinese balloon down by a U.S. jet had inadvertently floated over the country after being blown off course. China insists that the balloon was a weather monitoring device. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
Chairman of the Federal Reserve is obviously an important job. What do you do to relieve the stress other than interviews like this?
As you know, I like to ride my bike.
I say, is that safe, riding a bike?
It's safe if you stay on the bike.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
If it's not a danger, then why'd they shoot these things down? They shot it down because they felt it was operating at an altitude that posed a threat to commercial aviation.
On the one hand, the administration is saying we don't yet know what these last three objects are, and we don't want to characterize them until we recover them. But on the other hand, it wasn't a threat. Both of those things can't be true.
Bottom line is, I think the Biden administration is being very careful and very thoughtful.
The balloon saga continues. That was Senators Marco Rubio,
Give me an update,
Tom Cotton,
balloon guy. Give me an update.
If you want the response from China, it reads a little something like this. This is from the Foreign Ministry spokesman. You'll love this quote. Try and translate this, Tom. China is strongly opposed to this and will take countermeasures against relevant U.S. entities that have undermined our sovereignty. That piece of it's interesting. And security to firmly safeguard our sovereignty and legitimate rights and interests. What does that mean?
I have no...
Our sovereignty, our sovereignty over American airspace. That's new.
To me, on a serious note, it's got to eventually fold into Taiwan, and I know that the newly ascendant Republican House is making visits to Taiwan. Maybe that's the stew of the balloons and Pelosi-like visits by the other side.
Okay, on the margins, there are some discussions about who owns the ultra high space over a country, because it's, basically
Okay, 40,000 feet.
80,000.
That's China's?
No, I'm not saying that that's true, but on the margins, there's a really peripheral kind of weak debate on that level. The more important conversation here is that China is trying to signal strength amidst a real bungling of a message that has become a very difficult place for the Chinese authorities to become.
Oh, it's totally embarrassing.
It's embarrassing.
It's highly embarrassing this last week, Tom, for the Chinese government.
Oh, yeah, huge. Oh, no, it's Stavridis, who I really lean on this, particularly with his international work with NATO, said this is a treasure trove of intelligence data that we will get.
What's amazing about this, Tom, is the aerial objects over the weekend. Still don't really know what they are.
Yeah, and I'm even hearing the dreaded word private, where, it could have been a party balloon from, I mean,
they're not party balloons, let's just be very clear. Balloons? But people are saying that they do not appear to be from China.
You've got the military shooting down things in American airspace.
Yeah.
And we don't know what they were.
Correct.
And it's kind of nuts, Tom.
Oh, yeah.
I mean, you can shake this off as balloon gate and laugh about it, but, it's pretty serious stuff.
It is. Let's migrate on to other topics in Washington.
Lisa's laughing about it.
Yeah. Well, no, I think it's more the
Terry
aliens.
Haynes is laughing about it, too.
No, it's more that we basically have had a serious discussion about aliens with this administration. That is humorous.
A snapshot quickly to Edinburgh, Scotland, where Sturgeon is shocking Westminster and exiting. She is announcing her resignation. We're not going to go into the details of it, but we are going to go to Terry Haynes, founder of Pangea Policy in Washington. And Terry, I'm not going to mince words. Basically, my amateur take is the lady from Scotland is resigning because her party has had it with her. What do the various Republican candidates face with the devoted Trump party members along the path to November next year?
You've got, by the way, Tom, you've got two things going on with in the UK today. One, you've got Sturgeon, who's bumping up against massive unpopularity, controversial policy, and inability to deal with independence. And you've also got Keir Starmer kicking the former leader Corbyn out.
Corbyn out. Yeah, I saw that.
And you've got there's a similar kind of migration going on both in the Democratic and Republican Party here, where Republicans, to your question, are trying to get past Trump, and they really have for the last couple of years. That's accelerating. You're starting to see with Governor Haley and some other folks poised to get into the race, how successful they'll be on that.
But on a granular basis in the voting booths of the primary, are Republicans in name only, as President Trump would call them, are they in for a rude awakening?
I think that largely depends on the quality of the candidates and, frankly, how many there are. It's generally forgotten that Trump had about a hard 30% in 2016, and he's probably got a little less than that today.
Interesting.
But there were so many other candidates that he ended up prevailing in a lot of primaries. If you coalesce around a Trump alternative, if you will, somebody with the positives and without the negatives, Trump could be upended rather easily, I think.
Terry, do you think the organization exists within the Republican Party to do that right now, or do you imagine this field's going to be massive by the time we get around to the primaries?
Well, I think two things, John. One is organization gives political parties too much credit, but there are clearly lots of efforts, both kind of on the political side and on the money side. You notice a lot of these large money networks that used to support Trump are now going elsewhere. And what you've got on top of that, frankly, is an ability to push a different kind of post-Trump narrative that appeals to a lot of people. So I think there's a lot of room here for alternatives. And a lot of these candidates, I think, frankly, are running for cabinet positions rather than presidency.
No. No, I'm shocked.
I know, shocker.
I'm shocked.
Well, but for whom, right? And for what party, right? Is this a party of the center that is moving more to the center, or is this really ultimately going to drive it back more to the edges simply because that is where the critical mass is?
Well, right, Lisa. Both political parties have the same problem, essentially, which is that, in order to get through the primaries, you need to appeal to kind of the core purists, if you will, and then in the general kind of move back towards the center. That problem doesn't go away this time, but what matters and what changes, I think, is the candidates and the quality of the candidates. You're going to see Haley getting in. You're going to see DeSantis getting in. You're probably going to see Senator Scott of South Carolina getting in. Who's a very intriguing candidate. There'll be lots of post-Trump alternatives in the Republican Party.
To end where we began with Balloongate, there's one uniting feature with both Republicans and the Democrats, which is a hawkishness against China. And I wonder how much that desire to appear hawkish will prompt this relationship to spiral much lower, and what you're kind of expecting the contours of that discussion to look like.
Well, I think you were all correct a minute ago in talking about this being an embarrassment for China. It's not the United States' greatest hour either, since we've had lots of different explanations about balloons and how early we detected them and all that sort of thing. But there will be a desire to resume the cold peace here, I think. For markets, though, I think what this means is up defense stocks for quite some time.
Terry Haynes, I think that's the conclusion for a lot of people. Terry Haynes there of Pangea Policy on the latest with China and the Republican race heating up before the primaries even get started, Tom.
It's long. As I've said repeatedly,
said that a few times.
I yearn, but, here we are. We started. Who's next? I mean, I haven't seen within the zeitgeist the gaming of...
We know the names, DeSantis, Pence, take your pick, Pompeo,
what
maybe.
What does DeSantis do? I mean, does he wait? Does he wait to see if President Trump jumps in and then I don't know.
Well, he is officially in, the former president, right?
Should we do a Sunday talk show? Could you see us in here Sunday?
What would you like to talk about? Just football?
We could do English football.
Football blended with politics.
Really?
Nice.
Bramo on football.
So what else are you going to assign us? Where's our next road trip? And we're going to be here every Sunday.
Where are we doing that show? Where's that
exactly. That's
Well,
going to be in Capri.
I'm talking about, the scuttlebutt is there's an American looking at the tots and for just under $4 billion.
Iranian American, I saw that.
Yes, I saw that.
Yeah, in
so
EFT.
we have to build up that, I mean, I don't want Mr. Levy to leave. We've got a great relationship with him, but, I just can see us at some big game of the tots doing the broadcast.
We should form a consortium, Tom.
I don't want to talk to
get
Harry.
behind a bid.
Full disclosure, folks, I don't want to talk to Mr. Kane. I want to talk to Emerson Royale. I think he's just like lights up.
Are we talking about the score yesterday afternoon, or are we pretending that didn't happen?
How bad did they lose? Because they were just sort of like sleepwalking.
Yeah, I think Milan probably should have walked away 2-3-0.
Yeah.
But walked away 1-0 and go to
So is it over? I don't know the rules. Are they like done?
Second leg's in a few weeks' time.
It's the second leg. They're legging in.
They're legging in, so to speak. I want to talk about Tesla briefly. The stock is positive by 0.7%. Production line upgrades are not unusual. This is the latest from Tesla. They will halt some production at its Shanghai factory until the end of February as it upgrades the facility to start rolling out a revamped version of the Model 3 in the Chinese market. Tom, this according to people familiar with the matter.
Can we talk inflation? Can we come back to that from yesterday?
Want to jump to that? Sure.
I did a really adult, fancy chart of New York City rents. And I won't go into the details, but it was very carefully done. If you take the decade 09 to before the pandemic, we are 5 standard deviations out on a rent surge. I couldn't imagine that, let alone see it on the Bloomberg screen.
Since you pivoted back to that, are you moving? Is that on your agenda?
Well,
is that
I don't.
something that's high
We're
up on your list
and we're trying
this
to
morning?
finally, we may expand out. I'm thinking 1,200 feet.
Oh, nice. Nice to fit the whole family in.
As opposed to what, the studio?
Futures down 1/3% from New York. This is Bloomberg.
one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Live from New York, equity futures backing away by 1/3 on the S&P 500. Yields pushing through 460 in yesterday's session, and this equity market didn't budge. It was unchanged. That was a surprise for a lot of people. Equity futures come back down 1/3 on the S&P. On the Nasdaq, down 0.4%. Your bond market looks a little something like this. Your 2-year in a basis point still at 460.54 on a 2-year. I mentioned this a little bit earlier, but the last time the 2-year was here, the S&P 500 was way south of where we are.
3,800?
About 3,800 on the S&P. The last time we were staring down the barrel of 460, 470 on a 2-year. So there you go. That's where we're at right now. This bond market confronting a chorus of Fed speak in the last 24 hours, pushing for more rate hikes. The Philadelphia Fed President Patrick Harker said, we're reaching a point where we'll have done enough. Tom, it's going to be above 5%. How much above 5? It's going to depend on a lot of what we're seeing. Retail sales, the next stop here, 2 hours away.
Yeah, there's a huge mix here. I thought the research report's off the inflation report. I think it's going to be the same here at 9 o'clock, 10 o'clock, 11 o'clock this morning of retail. Let's not mince words. Julian Emanuel working with Ed Hyman, and Mr. Hyman reaffirms 2.5% inflation by the end of the year. Is that suddenly an outlier?
What's the rate call that goes with that?
Don't know. Didn't read that far.
Okay, well, that's kind of important. How high does the
Fed
need to go to achieve
that? I mean, that means Ed's looking for a lower 10-year yield. I mean, is what it sums to me. But it's a jumble right now.
I couldn't agree more.
Yeah.
The sense I got speaking to the Richmond Fed President Tom Barkin yesterday is there is still so much they don't know about this economy. Well, they're kind of still feeling their way through it at the moment.
Well, it's original. It's off the pandemic, and that's the question: is what kind of inflation is it, and what kind of retail sales? We get a combined Tuesday, Wednesday brief with Sarah House, senior economist at Wells Fargo. Sarah, link these two reports together. How do you, as a pro, link Inflation Tuesday with Retail Wednesday? How do you do that?
Right, so I think it comes down to what is happening in that demand environment. What is the consumer willing to spend, and how does that feed back through into the inflation dynamic? So we have seen disinflationary pressures begin to mount, and some of that's just supply chain dynamics unwinding, but a big portion of that too is what happens in terms of that consumer demand, particularly given the battle against inflation that real incomes have been under over the past year.
Are we in aggregate America? Wells Fargo's been acclaimed at this in your research for decades. When you look at inflation, or particularly looking at retail sales here in 2 hours, do we have a retail countdown clock?
We should get one.
We should get a retail count. Let's work on that, a retail countdown clock. Sarah, I'm fascinated by, do you aggregate retail sales? Or are they polarized with the haves doing well and maybe the rest of America flat on their retail back?
Well, we still tend to look at retail sales in terms of the aggregate. Unfortunately, it's tough to get some of the more detailed look at how different consumer segments are doing. But I think you can tell by the different categories of retail sales, how consumers are reacting. So for example, when you adjust for inflation, we've seen spending at grocery sales decline a little bit, I think suggesting that those lower income consumers are getting squeezed. So I think there is still some parsing that you can do, but I think overall we're looking at a picture where consumer spending is losing momentum. So yes, we're going to get a pop, we think, in the retail sales number today, even on a real basis, but you have to look at what's been the trend over the past few months, and we ended the year with a pretty big dud, so two months of negative retail spending.
You've been out front on this, Sarah. You believe in a rapid disinflation despite some of the recent hiccups. How do you then look past what we saw yesterday and double down on this idea of a rapid decline in the inflation rate to a point this year?
Well, so I think we've actually been pretty conservative on how fast inflation is going to come down. So I think directionally we're optimistic that it is easing, but I don't think it's going to be quite as quick work as I think many were thinking, particularly after the December CPI report. So yes, you're seeing a lot of downward pressure when it comes to the goods side, particularly in the vehicle sector as the inventory recovers. You can see the shelter relief coming in sight over this coming year. But I think when we look at some of the underlying drivers, particularly when it comes to the labor market, that's actually going to make it difficult to get all the way back to 2% on a sustained basis. So it goes back to that discussion of the last mile, where we can get some quick improvement here in the near term, but getting all the way back to 2% and sticking that landing is going to be pretty tricky, considering you still have a lot of inflationary pressure emanating from the labor market.
I want to build on the last mile idea, which you have been out front on, but before we get there, I'm curious, have you increased your terminal rate expectation after yesterday's print?
So heading into even the January jobs report, so we were looking at a terminal rate of just over 5%, so between 5.25% for that target range. I think that was maybe looking like a little bit of a push, considering the deceleration in activity we saw in some of the November and December, both spending and production numbers. But I think with the data we've seen over the past couple weeks, not just the payrolls, but also the upward revisions to some of the inflation data, as well as yesterday's report, that's still looking like a pretty comfortable call. So I think we're feeling pretty good about where we are. There's a lot that can happen between now and the June meeting, which would imply perhaps even raising that terminal rate further. So we'll get another 4 employment report. So I think for now that's still a pretty good position, and we're comfortable with that 5.25% range right now.
Talking about the last mile, getting from 3.5% to 2% inflation, we had Ken Rogoff of Harvard University on yesterday, and he was basically saying the Fed is going to allow inflation to run hotter. The terminal rate will be higher than it has been in the past. Adam Posen saying the same thing. Do you hear a growing number of economists and thinkers pushing for this, saying it's not really that important to get all the way down to that last mile?
Well, I think we've seen the Fed, after the tremendous bout of inflation we've seen, they want to demonstrate their commitment to that 2% target, and especially even if you think of it on that average basis, well, even accounting for the slow increase in inflation, where it was averaging below the 2% target, looking back even through the Great Recession, we've now averaged 2%, and so I think there's still that commitment to get it back down. But I think sure, you might see the Fed willing to live with 2.25%, 2.3% if the difference is really seeing the labor market fall apart.
Sarah, dumb question. Is Amazon in retail sales the report this morning, and is it like a big deal, or is it just a smaller number?
No, it's in there, and it's a pretty big deal. So that shows up in the non-store retailers, and you can really see some of their activities move the overall numbers around. So for example, when you have Prime Day, or the timing of Prime Day shifts, and the seasonals are having trouble keeping up with it, you can really see it in that non-store segment. So it is absolutely in there.
I mean, I look at what we saw. Liz Young had out the great chart showing shelter is well in food. Is food in retail sales?
Yeah, so food's in there in two places. So one, you get the grocery stores, and so you can see what that cost of food at home is. But the one services side that we get a glimpse at in today's retail spending report is what happens at your food services and drinking establishments. You do get some hint at what's happening with some of that discretionary services spending, but also you do have to think about what's happening on the inflation side there, just given how much labor costs and well as the food input costs have grown over the past year.
So what do you forecast for that?
So we don't get quite that far into the weeds in terms of that specific one, but you did see another pretty big jump in terms of the inflation rate for food away from home. So you're going to have to take whatever change we get with that and discount it by basically 0.6% to get what's the real services spending signal that we're getting from the retail sales report.
This is key data.
I understand.
This is key data.
You've got some key insight on it.
I do.
We have
ample forecast.
You moved the dial.
I think it's really interesting, and
Sure.
I mean, what Sarah's tearing apart there is the two worlds of. Anecdotally, people are telling me it's a crazy boom economy. The restaurants are packed and all.
Yeah.
And Paul Ajuz at Citigroup publishes this morning saying their charge card sales for a window of January, February were as grim as they were in early November.
That's interesting.
I don't, that's
Bank
why
of
I
America's
asked.
card data was great.
Yeah, I don't.
MasterCard as well.
Yeah,
Interesting.
It's a jumble.
Sarah House of Wells Fargo. Sarah, thank you. Bank of America looking for a really punchy number off the back of that card spending data.
Yeah.
They're looking for 2.6% month over month spike in core control sales. That's a
Headline,
big figure.
Headline, Lufthansa, they paid their bill to Deutsche Telekom.
Some flight operations have restarted. All Frankfurt flights remain grounded. I mean, this is kind of nuts, isn't it? So if you're just tuning in, earlier on today, the German carrier Lufthansa, which incidentally is the biggest carrier in Europe, had to ground all flights. They later explained the IT system outage was caused by Deutsche Telekom cutting a cable doing construction works in the Frankfurt area. Tom, they expect the IT problem to be resolved in the early evening. So the latest update, some flight operations have restarted, but all Frankfurt flights remain grounded. Not a great start to the week for this company.
Could I give you my Frankfurt story? You had a great
please.
one earlier.
I shared mine, you share yours.
I land and I'm late to the ECB as they're opening to see Ottmar Issing, who's a giant in economics. It was such an honor to spend 2 days with Dr. Issing, and we've done some other things for Bloomberg over the years. So I get in the car, John, and I am the American tourist.
What did you say?
The guy's in a Mercedes taxi cab or whatever. I go, I'm late to the ECB. Can you get me there fast? I look out the Autobahn or whatever, that I've never seen the trees go by that fast.
He really put his foot down.
I think he was going 110. I don't know. Oh, they were flying.
Wow.
The whole German flying.
No speed limit, Bramo. What were you like?
Can I say, I actually think this is a fascinating story from a larger perspective as well, because we've been talking about the revenge of the real economy, the revenge of the real industrial world, and we're so hinged on all of the data that we can transmit infinitesimally in seconds through these fiber cables, and then there are actually people who have to lay them down, and they're physical cables, and if they get cut, our world as we know it ends. And it's sort of that sort of dissonance which is leaving a lot of pitfalls and the lack of investment in that physicality.
You had to darken the mood with something serious, didn't you? Yeah, I know. Deadly serious stuff. I agree. We're going to talk about it next, and you can have that conversation. Terry Wiseman's going to join us at 8:30 Eastern Time as well.
Good.
On rates, current season, the latest retail sales. The latest from Mohamed Al-Arian. He says this, it's far from over, Tom. The lead is meagre for AC Milan, having to travel to London for the second leg. Bottom line,
know that.
Mr. Ferro should be as worried as you. It's lovely to hear from Mohamed, not talk about the economy of the Fed, but try and throw mud at my
Can I ask you a question to his beloved Queen's Park's Rangers of Shepherd's Bush?
QPR, yeah.
Are they in the Champions League running?
No, they're not.
It's just Premier League and the bigger teams.
They're in the lower leagues.
So this is sort of like a Super League try.
Kinda.
Kinda.
But not really.
Okay.
Was that a dig at QPR at the same time?
No, I would never do that.
Mohammed's going to love that.
Mohammed wants us to do the show from QPR.
Does he really?
Yeah, he'd come down.
That'd be nice.
Shepherd's Bush, the whole thing.
You've been to that stadium before?
No, I have not
Nice
been to the
stadium.
stadium.
Nice
But,
stadium.
they play Richmond here in season 3, and it'll be interesting to see QPR.
Of course.
Yeah, Richmond went down.
Yeah, of course.
They believe.
This is all about Ted Lasso.
Yes.
I forget. From New York, this is Bloomberg.